Good morning. It's almost 8:30 a.m. here in New York City. I'm Brad Smith alongside Brian Sazi this morning. This is Yahoo Finance, and it's Jobs Day. Happy Jobs Day to all who celebrate out there. We certainly do. Non-farm payrolls, they are expected to show a gain of 190,000 non-farm payrolls for the month of June here. We're standing by for this number that's going to be crossing in just about 90 seconds here, Saz. You've been tracking one main figure kind of coming into this report.
Hey, do we really celebrate this?
I mean, we should.
Okay, I guess we should.
Jobs, we should celebrate.
Well, you won't be celebrating if we get that Goldman Sachs number looking up for 140,000 on the headlines. That would not be good. I'm looking at immigration, really good chart by the folks over at Morgan Stanley into this jobs report, noting that immigration began to slow in March. And at what point, Brad, there you see that chart right there on that screen. What point does some of this data start to show up in various aspects of the jobs report, such as the construction market and the leisure payrolls, to be determined or TBD?
Yeah, you know, I'm keeping a close tab on the sectors here, and here's why. Coming off of that ADP print, where we had actually spoken with the chief economist of ADP, Naylor Richardson, earlier this week, who let us know that, and had put in this release for ADP, that if it was not for leisure and hospitality and that sector, they actually would have seen a decline overall in aggregate. And so that is one major sector to keep a close tab on, keep an eye on going into this report. And then, of course, looking at some of the wage figures that we're kind of keeping tabs on coming into this right now. Average hourly earnings month over month are anticipated to rise by about 0.3%. That's the Bloomberg consensus right now. Average hourly earnings year over year, 3.9% wage growth is what we're expecting there. And there you're seeing the unemployment rate anticipation on your screen.
And lastly, Brad, we're also watching the unemployment rate has ticked up from 3.4% a couple months ago to 4%. What does this all mean to the Biden presidency? Big interview with him tonight. The world will be watching. I think the last thing he needs is a bad jobs report here.
All right, we are 5 seconds away from getting that jobs report, and as we're keeping close eye on the futures, they are positive going into it. Let's take a look at the numbers that are crossing now. We've got 206,000 jobs that were added versus the 190,000 jobs expected. So that better than expected here. The unemployment rate ticks higher to 4.1%. Average hourly earnings month over month came in at 0.3%. And you also saw the year over year figure for average hourly earnings move to 3.9%, ultimately unchanged from what we had seen prior. As of right now, taking a look at the futures, we're seeing much of the same that we were just seeing a moment ago, where much of the futures activity is still leaning positive at this juncture. So we'll see exactly what this does to the CME FedWatch probability as well.
Speaking of government jobs up 70,000. Really want to highlight one thing here real quick before we get to our Jared Blickery on markets. Downward revisions to April by 57,000, downward revision to May by 54,000. And you have to think, what does this mean in the context of inflation? Initially, this report may suggest perhaps we are back on the table for that September rate cut. But let's get over to Jared, who's watching some of these early market moves. Very interesting report here, Jared.
Yeah, I'm looking at the 2-year Treasury note futures, and so these move inversely to yield, and what we're seeing is a spike higher here on the report. So that means yields are dropping. Not too many worries about that higher for longer. That was a 2-year. These are 10-year note futures, up 30 basis points, so similar boat there. And let's see what's going on in the stock futures. You can see S&P futures have rallied to their prior overnight high, which happened about the European Open, but we're only talking about 13 basis points. This is not a big move by any stretch. And in fact, we usually see a little bit of a fake out on these days, so we might end up going the opposite direction once the market actually opens. Here are Dow futures. You can see similar chart, but didn't quite make it up to their prior high here. And then let's check out what's going on with gold. We can see a little bit of a jump higher, maybe some concerns about inflation. Didn't really see too hot a wage growth number, but that's one factor that happens, or that's one of the things we see sometimes when we see gold futures heading higher here. And then here are copper futures, basically unchanged. Do want to check out what's going on with Bitcoin, because sometimes that does have a little bit of a delayed reaction. Not seeing any fireworks just yet, but we'll keep an eye on that. And then we got to check out what's going on in the sector action in stocks. And the background color is what happened on Friday, but you can see XLY there. That is the #1 pre-market gainer, up about 41 basis points, or 0.4% after closing up 0.6% on Friday. So we got kind of a mixed board. Energy trading to the downside, so is utilities, but not by a large margin. And then some of the other gainers I should note: real estate, staples, and financials. Tech just a little bit in the green there, guys.
All right, Jared, it'll be interesting to see what type of volume we see here today, given that this is the day after 4th of July. Perhaps a lot of traders away from those desks still, but We're going to be tracking this very closely. Jared, thanks so much for teeing up this next breakdown here. Joining us now to break down this latest June jobs number, we've got Joe Brusuelas, who is the RSM chief economist, good friend of the show. Joe, great to have you here on set. You were actually talking ahead of when we went live about this interesting dynamic about how if we see the jobs print, the non-farm payrolls come in higher than expected, then we might have actually seen this exact reaction in unemployment rate as well.
That's right. So look, guys, this is what full employment looks like. This is what you want to see. This is a very good number. Now, you know, the data viz we had up just before the number was released. You know, immigration's played a big role in not just growth of the economy, but growth in the labor market. Goldman put out that report, and they were right about that. It's slowed since March. And at one point, we're going to see these numbers come in a little bit lower. Last year, Jay Powell was talking about how he thought the break even in overall monthly unemployment gains was somewhere between 50 and 100. Now that was because we had that strong growth in labor supply. That's now slowing, so my sense is it's probably somewhere between 150 and 200 today. Nevertheless, this is another good, absolutely rock solid labor report. There's not much to complain about here. Moreover, if you're a market player and you see those downward revisions of 111,000 over the past couple months, hey guys, that's Fed positive.
Well, so isn't this the perfect report for Jay Powell? So you've had inflation start to decelerate. You have downward revisions. You don't have a too hot report. That has to put a September rate cut on deck here.
No, it does. As a matter of fact, look, guys, a policy rate in a range between 5.25 and 5.5% is no longer appropriate for an economy that has an inflation rate of 2.6%. Taken out to 3 decimals is 2.563, right? Moreover, growth is cooling. Hiring is cooling. The economy is normalizing. We're moving back to that pre-pandemic trend. You know, the large and persistent shocks that we've all lived through the past couple of years, I think we often undercount that or really underestimate just what it's done to the economy. This is unambiguous good news here, guys. This is what you want to see. That fireworks show we all watched last night, they should rerun it again after this report.
I see this report, and this is not a stock recommendation. I'm thinking if I'm trading, this is a buy Nvidia, Apple type of market. Not too hot a jobs report. You have lower interest rates. I mean, why not just stick with what's working in tech?
I mean, well, you want to be able to mute at least one part of the kind of investment calculus, and so far muted. Higher for longer has meant the Fed's going to be muted, at least for this interim period, which has led to that exact trade that you're talking about, or at least solidified it. I'm taking a look at the CME FedWatch probability here and tabbing over to that month that you were just mentioning, Saz, and Joe, you were discussing as well here. We actually saw a slight tick lower, just barely here, but I mean, the probability is still largely pointing towards a rate cut.
They're not right. I'm right. That's right. Just close that down.
The deceleration in our hourly earnings to 0.3% on the month, 3.9% year over year, along with those downward revisions, that tells me we can take off the table any notion of wage inflation really being on the table. Guys, I'm more comfortable with the Fed actually hinting in July that they were going to go in September. If I'm a Fed member, I'm actually thinking about July. They want to get out in front of what's going to be a decelerating job market.
So Joe, this report might be good for markets, tech investors, but is it good for the president? Now, he's had a rough week and he may have a rough few more days, but you have a decelerating job market and the unemployment rate is going to go up. On the weekend papers, you're going to see unemployment rate is on an uptrend, job market slowing. I mean, this is not good for him.
So my sense is that the U.S. presidential election right now is about things other than the U.S. economy. U.S. economy is going to be a second order story probably through November 5th. Look, you know, headlines are headlines. The American people know 4% unemployment, that's really good. That means I can get a job, my wages are going up, and look, guys.
But they don't feel good.
So the economy has a funny way of trumping ideology and politics, right? At a certain point, that increase in wages above inflation does tend to take hold. Moreover, at the end of the day, what do we all see? We see them out spending. We see them out traveling. I mean, I gotta go to the airport tomorrow morning. We're leaving extra early because over at LaGuardia, it's gonna be a royal mess because people are out spending hard-earned money.
I mean, I know what I'm seeing.
They're doing well.
I spent $7 on a bag of cauliflower chips yesterday, and the bag was smaller. I mean, that's what people are seeing. I mean, and they're concerned. But anyway, I mean, your point is well taken. Your point is well taken.
You also cooked that tomahawk steak that you sent me a photo of.
You off ceremony for something.
So, I mean, at the end of the day, and I was taking a look at one of the notes that was out from BlackRock as they were talking about continued disinflation and allowing maintenance cuts here. You know, how do you look at disinflation as we're seeing it right now, and what that means for some of the positive developments that we would need to see towards the back half and continuing in the back half of this year to set forth a rate cut pathway, even more so in 2025.
All right, so the Fed has been really consistent on this. They don't need to see disinflation or inflation get to the target of 2% on the top line PCE. Our forecast says we're going to be at 2.3% by the end of the year. Look, guys, we're within shouting distance of it now. If you want to get out and get in front of this and not have the Fed be behind the curve, they need to begin shaping expectations, I think, of that rate cut in September. That's been our call for a long time. We've got 25 on the table in September and again in December. Again, but I'm comfortable even with them considering July at this point because I do think the growth in the economy, or the economy's just normalizing. I want to be clear here, guys. This isn't a crack in the job market. It's not the economy's foundations cracking. We're moving back to trend. You know, when I see 206, and I think they probably overestimated by 20 to 40, hey guys, that's sustainable. This is very good stuff.
Do you see a catalyst in place to drive a re-acceleration in these jobs numbers?
No, I just don't see that, right? You know, job openings are going to move up and down every month, but my sense here is that firms have retained labor for a very long period of time. Demand's now cooling. They're not going to continue to hoard labor like they have been. So we expect unemployment, our forecast was 4.2% by the end of the year. That's looking pretty good here on July 5th.
Yeah. 8 p.m., where are you going to be tonight, Joe?
I'm going to be watching the president talk tonight, like I think we all should.
Yeah.
Get out there and register to vote. It's important.
Joe Boswell, it's always good to see you, RSM Chief Economist. We'll talk to you soon. Have a good weekend. All right, once again, June jobs coming in a bit higher than expected, adding 206,000. The unemployment rate ticking up to 4.1%. We're seeing stock futures, maybe a little bit of a bullish bias. There we go. You see Dow futures, S&P 500, and Nasdaq all up slightly across the board. We'll be right back with more analysis on what this report means for some of your favorite stocks like Nvidia and Apple, like I just mentioned. Don't go anywhere. The U.S. adding 206,000 jobs in June. We want to dive deeper into this report and the market's reaction with Daniel Zhao, Glassdoor senior economist, Harry Colvin, Longview Economics director and senior market strategist, and Steve Sosnick, Interactive Brokers chief strategist. Wow, lots of folks in this box. Good to see you all. Thanks for doing this after the holidays. Steve, I want to go right to you, and I want to get your instant take on some stocks here. So I think we were just talking to Joe Bersuelos about this. You saw the downward revisions in the jobs in the prior 2 months. Maybe the expectation of inflation slowing down sets the stage for that September rate cut. I mean, this has to be good news for some of the market's hottest stocks like Nvidia, Apple, Amazon, right?
Morning, Brian. Good news? I don't know. Enough news to upset the momentum trend? No, this does nothing. This does nothing. If you've been riding the Momo train, then there's no reason right now, based on these numbers, to get off. What it's telling us today is that the economy does seem to be slowing down, decelerating a bit. I guess the real question will come later this month when the Fed meets, and we'll get a sense of how nervous they are about it, because it does seem that the economy is beginning to decelerate. And then the question becomes, what are they willing to do about it? In the short term, though, we've been on such a momentum high. It's tough to just say that this number changes anything meaningfully about the stocks that have been driving the market higher.
Let's stay with the markets for a hot second, Harry. I'll come your way here, and we're staring down another earnings season. What, at least from the economic prints that we're getting, what could this spell out in terms of a broader theme or narrative that you hear from a lot of the CEOs over the course of the next couple months?
Well, I think it comes back to that point that one of your guests alluded to earlier, which was that companies have been hoarding a lot of labor. That was certainly the story 12, 18 months ago. And certainly if you look at the leading indicators of the labor market, companies are telling us they want to let go of some of the excess. They want to trim a bit of the fat, get a little bit more efficient. And I think we're beginning to see some of the softness coming through in the labor market. We had these downward revisions on the headline, on the establishment survey. I would say as well, you've got to look at the household survey, because it's probably giving you a much better read of what's really going on in the US economy, when the establishment survey is only asking the same large companies every month about hiring. And as you see in the ADP report, that's where all the job creation is. Look at small companies. Actually, there's not a lot of job creation. That hiring in small, or total jobs in small companies, has been flat for most of the past year. And so the household survey is picking up on that, and it's showing that really the job market is actually much softer than one would think from just looking at these headline numbers. So I think there's softness emerging, and this is fascinating really for the debate around inflation and rates.
Daniel, another somewhat decent jobs report here. What does this say about some of President Biden's policies and their impact on the economy?
Well, I think it's always tough to attribute the growth in the jobs market or in the economy overall specifically to president's policies. But overall, we do see that the job market has been much more resilient over the last 3+ years than we've expected. Like, that's been the refrain, that the job market is stubbornly resilient and in fact stronger than a lot of forecasters would have expected going in. So overall, we are seeing that the job market is surprisingly resilient. It is cooling. Like, we didn't get fireworks today, but we weren't necessarily looking for fireworks as policymakers look for the economy and the job market to cool down to get inflation under control.
Steve, what is the kind of trend that we're seeing in economic data, at least right now, set up for the second half playbook for investors out there?
Well, Brad, the question becomes, we rallied this year as the economy strengthened, allowing the rate cut expectations to dissipate. Now the question is, if we're flipping back to rate cut expectations, and last I just checked beforehand, we were about at 80% for a cut in September now. Is that because the economy's slowing? So, does the market get it both ways? Do we like it if the economy's strong and no rate cuts? And by the way, the economy's weak and we are getting rate cuts. That's where the question. That's why I bring back the importance of the July meeting, because the question is not necessarily 25 basis points here or there. The question becomes: is the Fed prepared to do something and to act, or are they going to wait until the problem might metastasize into something larger? So again, in the short term, this market is just so momentum driven, so driven by a small cadre of stocks. It doesn't necessarily make a difference until we start to see earnings results also later this month. By the way, there's a lot of things coming later this month, and you have a VIX, which is looking 30 days ahead, which is basically ignoring all this. So that's the other thing to sort of keep in mind as we go forward.
Steve, you and I always have these candid conversations on stocks. And tell me if I'm wrong, I just feel as though investors are complacent about things that are about to come right at them. You have a president fighting for his job. The other alternative is, we know what the other alternative is with Trump. Isn't the market being too complacent around political risk? And if I'm wrong, tell me I'm wrong and lay out your case.
Brian, you know I've never shied away from telling you when I thought you were wrong, and I don't think you're wrong this time. I think which is not to say
we're
I
going to have
think
to
you're
bring
wrong much of the time.
producers, please book Steve on the show again. We like Steve. We like Steve. You can tell me I'm right all the time.
But absolutely, that's what I was alluding to. Is we're looking at a period of complacency. Basically, the stock market didn't budge as the result of the debate and all the drama swirling around Biden. The bond market did move. It reacted negatively initially. It's since come back a bit. Again, we have earnings later this month. We have a Fed meeting that just became a bit more consequential later this month. And as I note, VIX is meant to give the market's best estimate of volatility over the coming 30 days. And it's telling you it doesn't expect any. A lot of that has to do with the fact that internals of the market, certain stock, if you have some of the stocks rising and some of the stocks falling, well, then that dampens the index. But it does tell me that markets just really don't seem to care as long as the Magnificent Seven and the adjacent stocks keep holding their own. Stock investors just aren't registering anything else.
Daniel, as I'm taking a look through this report, as I'm kind of thinking about all the commentary and this discussion here, it kind of brings me back to this thought that many of us were sitting here waiting for so many jobs to be replaced by artificial intelligence, and we continue to get readings about job growth, even if that is slowing. As of right now, does it seem like there's anywhere where we're seeing a massive kind of shift into AI-specific jobs being kind of taking over, I should say, some of the existing workforce participation?
We aren't really seeing it replace jobs yet. We do see from survey evidence, from talking to employers, like one of the most common ways that AI is being deployed right now is chatbots and marketing automation, right? So it's not necessarily the sexiest application of AI, not necessarily the high highs that AI practitioners have really promised, but it is starting to be used and it's starting to be experimented with, but not necessarily at a scale that you would expect to see an impact at the macroeconomic level. So it's possible if you look within marketing or content moderation, some of these jobs that might see a little bit of impact from AI, you could kind of see these micro impacts, but we're not really seeing it at the scale of macroeconomic level. We're not seeing mass job displacement.
Harry, last word to you, and we're not going to see these headlines today, I get it, but you're going to see it probably over the next week. You're going to see slowing job market, unemployment rate up, and people suggesting some form of 2025 recession, mid-2025, late 2025. It's just going to happen. Do you see anything in this report or in other data that you watch that would suggest that is a possibility, or they're just living in a different world?
No, I think there are lots of pieces of this report that are quite troubling and suggest that recession risk is certainly non-trivial in the next 12 months, particularly if you look, for example, at the very sharp fall we had in the number of people working temporary help jobs in the service sector. That normally falls before recessions. It's falling. Or you look at the number of people working part-time because they can't find a full-time job. It's trending up, often what happens before recession. Or you look at the number of permanent job losers also, that continues to trend up. So there are signs of cracks, there are signs of weakness. Is it a recession or is it just a soft patch? That's the question. Our view is it's probably just a soft patch, because you look at the health of the corporate sector, it's in very good shape. Throwing off free cash flow, margin expansion is good, profits are trending up. You don't tend to get recessions when company health is really good like it is today. In fact, what you get often is volatility in equity markets dying a death. And that's what we've been seeing this year. It's what we saw in 2017, in 2013, and other times when corporate sector risk has been very low.
Daniel Zhao, Harry Colvin, and Steve Sosnick, thanks for waking up early for us on this day after July 4th. Appreciate it. Have a good weekend. All right, the healthcare sector added 49,000 jobs in June, down from the 68,000 healthcare jobs added in May. Yahoo Finance senior healthcare reporter Anjali Kamlani has been digging into the numbers. Anjali?
That's right, Brian. We know that, of course, the healthcare jobs have been really adding at quite a clip in the last several months, but now we're seeing this downturn in the monthly average, 64,000. We saw 22,000 jobs added in the ambulatory healthcare services and 22,000 at hospitals, and those have been really the key areas of jobs added for the last several months. I've been looking into what has been happening in the last year. We saw those blowout numbers month over month for the last year, since April really of last year. And what is the story behind the story is really that we've seen a high turnover within the sector, and that's been one of the drivers of these job gains. Things like burnout, misaligned demand and supply between where jobs are and where jobs are being applied, as well as payer squeeze from the insurers, paying less and causing a little bit of a squeeze there for those hospitals and those healthcare systems. Meanwhile, costs are rising for those very same facilities with these burnouts. So it's really just a bad cycle right now for the healthcare sector, and this could be why we see a little bit of fluctuation. We do know that there are also shifts in where doctors and health clinicians are going, where it goes to maybe telehealth or other areas where there is better work-life balance. So those are all playing a role in what we see with these numbers month over month, and we did see a bit of a dip this month after really some record numbers if you take a look at sort of the history over it. But definitely keep an eye on how this pans out for the rest of the year.
All right, Anjali, thank you so much. Keeping close tabs on the healthcare sector. Now let's take a look at how futures are digesting the latest data, the latest jobs report coming in better than expected on headline. Unemployment did tick higher just a little bit here. Let's take a look at the Dow futures right now, up by about 0.1%. We're just a little over 30 minutes from the start of trade on this holiday abbreviated trading week. But on this Friday, we're seeing Nasdaq 100 futures move higher by about 0.1%. S&P 500 futures up by about 0.1% as well. We'll round that off too. Also want to take a look at some yields here this morning, as we did see a little bit of a move on the 5 and the 10 year. Of course, the 5, the 10, and 30 are down here, but we are seeing, of course, once that report hit, you did see a little bit of a dip on the 5-year yield. Right now, sitting at about 4.26 overall and moving lower by about 1.4%. But ultimately here, we're going to take a quick look at some of these sectors just before we wrap things up, as we're taking a look at, of course, that was the previous move that we had seen on the abbreviated trading session. That was Wednesday. And then now these numbers underneath that are in these nice little boxes for you. As of right now, it looks like we've got the most gain taking place in consumer discretionary here, intraday or extended hours, pre-markets up by about 0.6%. And then lastly, we know you like heat maps, so we'll give you a little bit more of a check-in on some of your favorite tech stocks here before the opening bell, as we're taking a look at a little bit of slippage here for some big names in Microsoft, Apple, and Nvidia. Fractional moves lower is all as of right now, so we'll keep close tabs on that. Amazon looks to hold on to some of those gains going into the start of trade, and Meta, which has had a rocker of a year as of right now, we're seeing that as of right now higher by about, we'll call it 0.1%. Year to date, you're also seeing that up by about 44%. Saz, I'll toss it back over to you.
Yeah, while you're at that board, Brad, just really good note real quick from Torsten Slok over at Apollo. Said the key discussion in markets will be whether this cooling will accelerate to the downside, of course, in the jobs market, or stay elevated because of still high financing costs or interest rates. Interesting stuff from there from Torsten. All right, nonetheless, later this hour, we will speak with acting U.S. Labor Secretary Julie Su to get her take on the jobs report. We'll be right back. It's 9 a.m. here in New York City. I'm Brian Sazzi alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief.
That's right. Stock futures rising this morning after the June jobs report shows some welcome signs of cooling here. Yahoo Finance's Jared Blickery, Inez Ferre, and Akiko Fujita have more.
That's right. The U.S. labor market adding more jobs than expected during June. Non-farm payrolls came in at 206,000, beating expectations of 190,000. Meanwhile, unemployment unexpectedly rose, hitting its highest level since 2021 in a welcome sign of cooling for the jobs market.
And crypto crashing, Bitcoin plummeting down past the 55,000 mark. The spiral sparked by news that the collapsed crypto exchange Mt. Gox has begun making repayments of Bitcoin to creditors. Altcoins, including Ethereum and Binance Coin, are also getting hit hard on the news. In all, the markets are anticipating Mt. Gox will distribute around $9 billion worth of coins to users, an influx that's expected to spur significant selling action. Today's action has Bitcoin on track for its worst week in more than a year.
And the UK's opposition Labour Party securing a landslide victory in a July 4th election, unseating the Conservative majority after 14 years. London listed stocks climbing on the results, led by house builder names. The new leadership welcomed by Wall Street names, Goldman Sachs upgrading its growth forecast for the nation after Labour's sweeping win, and RBC Capital Markets noting UK home builders could be in for a new age if Labour election promises turn into policy.
Futures are higher after the U.S. economy added more jobs than expected in June here. The data slightly tampering expectations for a rate cut in September. Over 71% of traders are betting on a cut all in, but that's down from before the report's release. For more on this, let's bring in Justin Bergen, who is the Ameriprise Financial Vice President of Equity Research here. Justin, thanks so much for taking the time here this morning. Let's just start off with the data that we saw come through in the jobs report here. I want to get your read in on it and what this signals for the pathway for rate cuts.
Yeah, absolutely. Thanks for having me this morning. I think one of your previous guests made a comment on fireworks, and I hope you saw him yesterday because it wasn't this morning. It was just a good report, right? I mean, you're adding over 200,000 jobs in a month. Your unemployment rate ticking up slightly, and your wage growth, that's 3.9%, right where it should be. So if you could put it in a what could go right, that out of that report, it sure beats what we got last month when there were quite a few fireworks.
Justin here, good to see you. I'm just going through the street reaction on this report. When do you see, or do you see, an acceleration in the economy, maybe because of higher stock prices and tighter credit spreads? That's some of the chatter that's coming into my box right now.
Yep. So actually, GDP is slowing, right? So if you look at where we were last year, our consensus forecast this year is for 2.1% growth. That's down from 3.5%. But if you look back at some of the previous periods, you go to 2018, 2019, when you had similar 2% GDP growth, and then you had wage or unemployment that was above where it is today. You had job growth below where it is today, and consumer spending was still strong. So to have a 2% GDP growth rate for the economy, that's a good place to be in.
Why is the unemployment rate going up?
But the Fed wants job growth to slow, plain and simple. It's not great. You have some of the low-end consumers that are being stressed, but you do have unemployment rate for the last 50 years has been, the average is well over 4.5%. So to be at this, below 4% for too long, it's very, very, very hard to have that type of wage growth.
What are the other characteristics then of normalization if we're getting back to trend on markers such as the unemployment rate?
Yep. So I think if you look at consumer spending, that's coming back down. You have the savings rate, that is coming back down. And I think if you kind of focus and shift at the earnings growth, you have 11% earnings growth estimates for this year. That's fantastic, right? I mean, Q2, you're looking at 8.8% growth. That's excellent growth for corporate profits. And you look at the profit margin, That's a 12% expectation for Q2. That's actually up quarter over quarter.
Is this report bullish or bearish for stocks?
Pardon?
Is this report bullish or bearish for stocks?
I think it's bullish, absolutely bullish. I think if you look at that's what economists want to see, is this slowing, gradual slowing of the economy. You have a job market that's not imploding. Consumer spending still continues to be strong. Corporate profits are strong. That's why the market keeps hitting highs. And if you have this 10-year coming down from 450, where it is now 430, 428, that's what they want. Lower rates is good for the economy.
Markets tend to look out, 6 months. They're pricing in the rate cuts as best as we're kind of looking across the moving dial of the probability for those rate cuts as well through the rest of this year, and even the frame of mind of how many we might see to start off next year. How and what would be a big impact for this market that would catch it by surprise, perhaps?
Yeah, so I think the question is not if there's going to be rate cuts, but when. And the other question is why, right? So if we have to start cutting rates faster than expected because the economy is falling off a cliff, that's negative. If we're cutting rates because we have this normalization in the economy, that's good, right? You can have that glide path that's trending lower and still continue at a 2% growth rate for GDP.
Has the president's policies been good for the job market?
At a 3.9% that we've had for quite some time, kicking up to 4.1, I think policies in general have been supportive of employment. And again, if we can have that continue to trend a little bit at the 4.2, 4.3, where our expectation is for unemployment to be 4.2% at the end of the year, that's that gradual decline. So I think if you look at where the policy of the administration are, you have been supportive of employment.
All right, we'll leave it there. Justin Bergen, Ameriprise Financial Vice President of Equity Research. Good to see you. Appreciate it.
Thank you.
The Bitcoin plunge. Collapsed exchange Mt. Gox, I think I said that right, is beginning to reportedly pay back the nearly $9 billion in Bitcoin and Bitcoin Cash it owes to customers from its bankruptcy in 2014, stoking fresh investor fears that the customers might quickly sell the coins. Yahoo Finance's Jared Blickery has more on this. Jared.
Brian, I'm guessing you're not a Mt. Gox customer, but good news for them. Over the next 60 to 90 days, they're going to get repaid. This was a bankruptcy that happened, well, it was actually a theft, a heist that led to a bankruptcy about 10 years ago. This was a Japanese-based exchange. They lost over 700,000 coins, Bitcoin specifically, and now the trustee is set to return about 140,000 to the market. Now, what you're seeing behind me, this is just one day's price action. A lot of dark red on your screen. Bitcoin down 4%, Ethereum down 6%. Here's what happened over the last 4 days. Bitcoin is down 12.78%. And I've been showing this year-to-date chart saying that anything that happens between these two lines here, this was a price consolidation channel, just sideways movement, it doesn't matter. Now that we've broken down below, well, that does matter. As you might know, we actually broke below this support level one time. That was a false breakdown. Is it another false breakdown? Looking on the length that price has traveled right now, it doesn't look like it, but I guess that is a possibility. You just need another day's price action to really confirm this. So we'll get that over the weekend. But what does this mean for the rest of the crypto enterprise, the rest of the crypto universe? Well, a lot of times Bitcoin is a leader here. So we're also seeing Ethereum get down to the bottom of its support range, but you'll notice it hasn't breached it just yet. Kind of supports the idea that if Bitcoin were to recover very quickly, you could say, okay, that's another false breakdown. But again, that's not my base case. Before we go, I do want to check out crypto stocks this morning. I'm going to put on some early quotes here, and you can see lots of downside action. HUT trading 7.5% to the downside. MasterStrategy down 7%. So just a lot of negative vibes in the crypto sphere today.
All right. Well, at least we have the positivity from Jared Blickery always. Jared, thanks so much. Appreciate it. Britain's Labour Party celebrate a landslide victory in the UK Prime Minister elections. For more on what this means for markets, let's get to Yahoo Finance's Akiko Fujita. Hey, Akiko.
Hey there, Brad. Yeah, we heard from new Prime Minister Keir Starmer just a short time ago outside Downing Street, setting expectations for how quickly his government is likely to move on key issues.
Now our country has voted decisively for change, for national renewal, and a return of politics to public service.
Starmer saying that changing a country is not like flicking a switch. This will take a while. And that expectation certainly reflected in the markets, with the FTSE now pairing those initial gains we saw at the start of trade. Now, we are seeing the pound firmly higher against the dollar, close to the high for the day as investors look for more political stability in the UK. This was a sweeping victory for the Labour Party, unseating the Conservative majority for the first time in 14 years. Much of that the result of voter discontent over the politics of the ruling party. But there is no question the economy played a key role here as well. The UK already the worst performing economy among G7 nations, with few expectations for a turnaround. Just a few months ago, the OECD slashed the outlook for the UK growth to just 0.4% this year and 1% next year. Brexit, the COVID hangover, the Russian invasion of Ukraine, all significant drivers for the slowdown, with voters also expressing anger over the lack of housing as well as the wait times for National Health Service, among other issues. The election outlook already leading to a key upgrade from Goldman Sachs this morning. The investment bank now saying it expects Labour's fiscal policy to provide, in their words, a modest boost to demand growth in the near term, raising its forecast for growth by 0.1% over the next 2 years. But Goldman also warning about potential risks stemming from increases in taxation and the impact that could have on incentives to invest. And also, Labour's push to reduce net migration. Goldman says that could tighten labor supply. We did hear from outgoing Prime Minister Rishi Sunak acknowledging the challenges ahead for the UK, although he did highlight the UK's return to 2% inflation in line with the ban. And guys, one more thing to point out here. Voter turnout was at 60%. That's close to a record low. And while the center-left party is celebrating its victories today, Nigel Farage, remember him, the driving force behind Brexit? He also found some success here in the election. His upstart right-leaning Reform UK taking a lot of the Tory votes, with Farage becoming a member of Parliament on his 8th try. Brad.
All right, Akiko, thanks for keeping close tabs on those election outcomes for us. Appreciate it very much. Everyone, President Biden facing pressures from Democratic donors as he faces a key stage in his re-election campaign. Yahoo Finance's senior columnist Rick Newman joins us here to discuss ahead of what's going to be a big weekend for Biden here. Rick, lay it out for us.
Well, the latest news is that some major Democratic donors are saying they are not going to donate any more money until Biden steps aside. Abigail Disney, one of those people. And some of these donors are setting up separate funding mechanisms for somebody other than Joe Biden. They're not necessarily picking a candidate. They're just saying Biden needs to step aside, and they're putting their money behind that. Abigail Disney's one of them. Mike Novogratz, the crypto billionaire, another one. Reed Hastings is another who are behind this. This just feels like a sinking ship, guys. It's one little development after another. And we're now getting to the point where Democrats are at war with themselves. And that is about as bad a scenario as you can have going into the final months of a presidential election. So Biden still saying, I'm in it to win it. He's going to do this interview today with George Stephanopoulos of ABC. I mean, the whole point of this interview is for Biden to take some tough questioning and be able to demonstrate that he's up to it, that he can explain away his terrible debate performance. But I got to tell you guys, it feels like the air is coming out of the Biden campaign.
Rick, 206,000 jobs created last month. Is this jobs report a good thing for Biden, or at this point, voters can care less? They just want to see him put some sentences together.
Job creation under Biden has been terrific. I mean, Biden says all the time, we've had the most jobs created during my administration in the history of the country, which is true, and it doesn't matter. I mean, he gets no credit for that from voters. People care way more about inflation at this point. Inflation has been coming down, but Biden is losing the narrative here. I mean, when he's now on the defensive constantly about his age. I think I saw another poll that said almost 80% of Americans now think Biden is too old to run. And he's only a couple of years older than Trump, but people don't think that Trump is too too old to run. So the jobs report, Biden will be talking about it for sure, but it's just not the thing that voters are paying attention to right now.
Is there anybody else right now who Democrats are looking at and ultimately has enough of an economic standing in order to signal to voters out there who are going to be thinking about issues like inflation, going to be thinking about issues like the broader employment trajectory right now, that could ultimately have that candidate kind of come out on top in any scenario?
Well, if Biden says he's not running, the immediate front runner for the candidacy is Kamala Harris. It would be hers to lose just by virtue of the fact that she's the vice president and her name is on the campaign. Plus, she would easily be able to use all the money that the Biden-Harris campaign has raised. So it would be hers to lose. And I think my way of thinking about it is she would basically take the handoff of a pretty good economy. And if she played it right, she would not have the baggage of inflation. So, I mean, Republicans have called it Bidenflation. They don't call it Harrisflation. So she would be able to say, hey, we're going to have a fresh start here, and by the way, don't blame me for inflation, the thing that bothers voters the most. So she would get a fresh start. Whether she would, effectively capitalize on that, I have no idea. I don't think anybody knows, but that's the way I would see it developing.
Yahoo financial columnist Rick Newman. We'll talk to you soon. Appreciate it.
Bye, guys.
All right, much more market analysis straight ahead. Stay tuned. You're watching The Morning Brief. Shares of Nvidia slightly in the red. The company has been bouncing back this week after a volatile period. Nvidia did get hit with a downgrade this morning from New Street Research. Analysts at the firm saying they see limited further upside and are downgrading the stock from buy to neutral. Well, Brett, everybody's trying to be a hero on Nvidia. All I know is I go back to a recent JP Morgan story, and it is report is very simple. Demand continues to outstrip supply for Nvidia chips, and as long as that continues to happen, there might be some volatility in the name. How do you dump this stock? I mean, they're a beast. They're on a path to potentially $10 trillion market cap.
You know, it's not a stock particularly that's just one that you talk about where it's just, okay, yeah, just trade this name. No, it is an investment decision that has now been regarded as such for a long-term kind of hold type of mindset. It's not something that you're trying to day trade at this juncture, even though it got a little bit more affordable after the stock split that took place in a couple weeks back.
Last thing you want to hear. So you call up your money manager and they tell you, hey, I hope you had a great July 4th. Yeah, I'm going to be lightening the load on Nvidia. Who the hell wants to hear that? I mean, that is the great way to lose your job and lose client money. I mean, it's tough to sell a stock that everybody is rightfully very bearish on for strong fundamental reasons. Yeah. I mean, the AI chip rollout, this is not late 90s .com stuff with companies not making any money. This is real stuff, real technology, and this company continues to be the leader by years. I mean, by years, they're leading other companies.
Well, the interesting kind of annexation, or at least .com bubble analogy that Nvidia has been drawn to time and time again now is actually Cisco. And if you go back and take a look at their stock chart, one of the things that you'll see that is quite similar here is this hockey stick type run up during the .com era, and then it had to grow into its valuation. Now, of course, it declined precipitously in the aftermath of that bubble bursting, but then eventually, over years, was able to grow into that valuation because people could see the applications and the use cases for the technology that they were bringing to the market. It's the same thing with Nvidia here. We just don't have a 1 million chip data center right now because it's not built up yet. And so that's perhaps the next part of this generative AI trade. When we talk about picks and shovels, it might literally be picks and shovels building up some of these data centers, picks and shovels putting some of the electricity in the ground or overhead or however you're building that grid out in order to make sure those data centers have the necessary utility and power that they need.
No, right on, Brad. And I think you have to be thinking about it's not just the Nvidia trade, it's the whole ecosystem. You had a great conversation on my podcast, Opening Bid, cheap plug for myself there, with Brooke Dane, portfolio manager at Goldman Sachs Asset Management. His, I think, view was, sure, you can continue to own Nvidia, but think about some of the companies that are trying to compete with the likes of Nvidia over the next 5 to 10 years. It's a Marvell, it's a KLA, it's a Micron. None of these companies are really going to take material market share from Nvidia today, but as long as they could sell that sizzle to investors, those stocks might rise along with Nvidia.
I listen to your podcast every time.
I appreciate that.
I mean, I sit right next to
it. So you don't download it. You don't download it.
I mean, look, I was in the pilot episode and then I never got invited back. I'm waiting to come back.
We could come back anytime you want.
Okay, done deal. Tomorrow?
Yeah.
Sounds great.
Yeah.
No, I won't be here. But anyway, we're tracking shares of Samsung this morning as well. They're jumping to their highest level since January 2021 after the company posted its fastest pace of sales and profit growth in years, thanks in large part to explosive demand for, get this, artificial intelligence. Take a look at shares. They're up by about 3% here. I mean, larger question of, and we've been trying to wrap our minds around this for a good bit of time, and it seems like late this year we'll get the first true glimpse of how consumers gravitate towards some of this technology at their fingertips, not just because of what Samsung is putting into the market, but also because of what Apple has promised they're going to be bringing to the market, as long as you have a certain iPhone or higher.
Yeah, Samsung doesn't really get me excited. I look at these Samsung results and I'm like, yeah, okay, they're selling some cool, expensive phones. What is the read through to Apple? And I think Apple's just having a recovery story in China. I think it's playing out, and that's my only read off of here, off Samsung.
I mean, the biggest thing with Samsung to remember, though, is the market share that they account for globally within the handset devices. I mean, Apple has been trying to, and Apple saw its highest kind of operating system marker at just barely shy of 20% globally last year. Samsung, for the Android operating system and how well that is able to be deployed to so many other handsets, Samsung is still able to hold its own, but it's seen its market share waning as a result of Apple's ability to take on more market share globally, focusing in on China, focusing in on India, and some of that international growth more specifically here. But it's going to come down to the price point right now that consumers are willing to actually buy into some of these new generative AI inducing, or, I don't even know what to call it.
You know what was so exciting? I saw a video and it looked real on X this morning. It looked maybe the new iPad.
Yeah.
And it was somebody doing mathematical calculations
that,
on it. And so they're writing 20 plus 20, and then all of a sudden the answer comes up. Why did I have this in like the mid 80s when like elementary school? But my takeaway was I'm watching this in real time.
Because there was no iPad.
Fair enough. But I'm watching this in real time. Bullish Nvidia, bullish Micron, bullish Marvell. I mean, that's the whole Nvidia trade right there in real time. The ability to write on something and it just gets, the answers come out. I mean, it's awesome.
Isn't it wild that one day we're going to have to tell our kids, I remember what the world was like before the internet?
Yeah, well, that assumes that one's going to have kids. All right, on the other side, we'll have that opening bell. I'm probably just not. It's just the reality. No, I'm just not. Okay. We'll have that opening bell on Wall Street on this jobs report Friday. You're watching the morning brief. Do not go anywhere.
Like a little Sazi running around?
No, not going to happen.
All right, we are just seconds away from the opening bell here on Wall Street and in Midtown Manhattan at the Nasdaq. And we're taking a look at the futures this morning. On this Jobs Friday, we should note, which has us back here in office and has us tracking the futures activity, which largely kind of unchanged since we got that report earlier this morning.
Hey, that's all we got? I mean, we had 206,000 on jobs. You have downward revisions to the prior 2 months. Now, lots of gets that we've talked to so far, looking for rate cuts, Brad.
Yeah. All right, here we have a live look at the opening bell. Sounding off on this Friday, July 5th. You got the great folks from Tungray Technologies ringing the opening bell at the Nasdaq. Some funfetti there on a Friday. And then you have the United States Merchant Marine Academy ringing the opening bell at the NYSE. All right. Great group of folks there on screen. Let's pivot to the markets here as we're taking a look at the major averages here and getting things recalibrated. But as of right now, you can see the Dow Jones Industrial Average beginning the day flat, just barely to the downside here. We've seen some hyper waffling out of the gate and even coming into the start of today's activity. You like that one?
I love when you say hyper waffling. Can I do this? I don't want to be a prop this time. I just want to touch that. I haven't been to touchscreen in a while. Nasdaq, I think that is the main focus point today, folks. What is leading stocks like Apple and Nvidia do after this report, which really, I think, strongly suggests of a rate cut in September? Theoretically, Apple, FANG stocks, Nvidia, they should do well with that type of backdrop.
Well, let's take a look at some of those stocks, too. If you hit that heat map button.
Go for it.
I got you.
I haven't done this in a while. What do you want me to do?
Look, we're knocking rust off here, and we're doing quite well. Let's take a look at the consumer discretionary. We've got 11 sectors pulled up on your screen here for you folks. Consumer discretionary leading the pack as of right now. Let's take a look at that year-to-date chart, up by about 5.5%. And, of course, as we're taking a look at some of the other red spots here, unfortunately, you've got energy pulling up the caboose. You mentioned some tech stocks. I know you like tech stocks. Let's give you some tech stocks here. Take a look no further than Nvidia. I'm sure it was the talk of the barbecue for a lot of people yesterday. They're just trying to figure out, okay, what is this AI trade? Does it still have legs here? Riveting up 157% year to date.
Yeah, good stuff. All right, Jared, let's get over to you are the true master of the touchscreen, where I'm just here, I don't know, marking up time.
Well, thank you. Let me just conjure this up here, and we'll get the sector action behind me. I like how you were looking at XLY. Consumer discretionary has been the story of the week. Let me just put a 4-day look at on our sector heat map. You can see XLY is the leader, up 3.2%. XLK, that's tech, close second behind. But you were just looking at that year-to-date chart. It is now broken through the upper end of its range. You take a look at a 5-year. It is still not eclipsing its prior year 2021 highs, but looks like it's on its way. So what are the biggest stocks in there? Well, guess what? In consumer discretionary, it is Tesla and also Amazon. And Tesla here, this is a 4-day look. Tesla up 25.8%, Amazon up 3%. So Tesla really doing a lot of the heavy lifting. This is a 5-year chart. And one of the things that stands out, Tesla is now just breaking out of this very long trend line that goes all the way back to its record highs in 2021. So this is a technical achievement for it. Doesn't mean that it's going to race higher right away, but this is a first step to a trend change around, which is higher highs and higher lows. So now we want to see a higher low as Tesla eventually comes back. Let's put this to an intraday view. I want to jump over to our meme stocks because I was tracking costs on Wednesday, and that stock was up over 100%. Just an incredible run. Let me put our equal weight here, and we can see cost is in the #1 spot. It is up 44%, just over 40% now, fluctuating pretty wildly. Here's a 5-year look. What stands out is this little jump here, which is actually a pretty big jump, nothing near the jump we saw in 2021. Nevertheless, I want to put this in context. I'll put a 5-day look. You can see there's the stock up 259% in 5 days, doing what meme stocks do best, confounding the fundamental analysis, I would say.
Jared, thank you so much. Appreciate it. Keeping tabs on the market movements that we're seeing out of the gate here on the day. Let's get back to Bitcoin here. Bitcoin sliding after Mt. Gox begins repaying users, inflaming fears that customers might quickly sell the coin. To discuss what investors should do now, we've got Lucy Gazmararian, who is the Token Bay Capital founder and managing partner. Lucy, great to have you here. Thanks for joining us here on this topic. I mean, what should we anticipate that some of the holders or hodlers may do as a result of Mt. Gox now?
So Mt. Gox has obviously been tracked, pretty thoroughly in Bitcoin circles. So it's an anticipated event. And there's also been a lot of trading of the claims prior to, all of this being sorted out on behalf of the creditors. So it's really up for debate as to whether 9 billion is going to sort of flow onto the markets in one go. And it's actually highly unlikely. So any selling is likely to be staggered over a period of time. And actually, there's a question as to whether there will be any sellers, because as I say, it's likely that many of the claims have already traded hands and people already are either going to hold Bitcoin for the longer term or they're going to sell. But it's unlikely to happen all at once. So it should be managed and the market should be able to absorb any supply coming through.
Lucy, there's I see a lot of the chatter on the various boards, on various crypto boards, very focused on what happens with this presidential election. Let's just handicap this. Let's say President Biden does decide to drop out. Someone else swoops in and takes his place. Who's the better person for the cryptocurrency market?
What's interesting is there are a lot more sort of pro-crypto voices in Congress, in US politics. And, we're getting so many more cheerleaders, and that's largely driven by this Stand with Crypto movement and the funding that they're actually getting from a coordinated attempt by all the big players in the crypto industry to really change the perception around crypto, really get people rooting for the new technology and, the infrastructure for a new generation of financial markets, and for politicians to see it as such and actually see it as an enabler and a way for the American economy to sort of get ahead and grow. And so I think they're having amazing success this year in doing so. There's a lot of funding coming through and there's a lot more voices. And it's not just the funding, but it's the education as well, with all these crypto groups that are going to DC and really explaining and sitting down with lawmakers to set out what this technology really can offer American people.
Coming into and even on the first half of this year, the crypto playbook was quite simple. It was ETF approvals and it was the halving. What does the second half playbook look like for crypto?
So I think, we've had a bit of a sell-off recently. I think with every wave that we have, we've got new buyers that are unused to this volatility. So it's not particularly nice experience to buy into the ETF in January, be really thrilled with 30% or 50% gains, and then be down 30%. That takes some getting used to. So we've got new buyers entering this market. And trading over the summer is typically quieter, right? You've got the quieter trading months over the summer, and Bitcoin is no exception, particularly now that we have Bitcoin listed on a national stock exchange. So there is going to be a degree of correlation there. The big question is, what's Bitcoin going to do when everyone comes back to work in the fall and the markets start picking up again? That's really when we can actually tell if Bitcoin's going to be in a deeper correction than is actually typical for most of the cycle. And to this point, we are still seeing very typical moves in Bitcoin's price.
If someone wanted to use this pullback, Lucy, as a buying opportunity, what should their first stop be?
It changes every time they break below. So it was 56. Now people are saying 48. Listen, I think a great investment advice, although I cannot give investment advice, is to dollar cost average your way into the asset class. So you have to take a long-term view on Bitcoin. You have to look at the fundamentals. If you're investing for 6 months or a year, that's going to be a pretty tricky trading strategy because the market goes through boom bust cycles. So the best thing to do with Bitcoin is dollar cost average in and hold it for the long term, because we are likely to see another cycle down towards the end of 2025 into 2026 as we get another cycle. When these cycles really arise out of this Bitcoin halving, which happens every 4 years. So I think as investors, you should really take a view on Bitcoin. Do you believe it's going to be a fundamental trading tool? Do you believe it's going to be the equivalent of the US dollar in a global digital economy? Do you think more emerging markets and governments are going to start stockpiling Bitcoin as a reserve asset? Take a view on what you actually think the utility of Bitcoin is, because there are many different narratives associated with Bitcoin. And, just buying it because you think it's going to go up, I would suggest having a longer term investment horizon.
Lucy Gazmarian, who is the Token Bay Capital founder and managing partner. Thank you so much.
Thank you.
Appreciate it. Coming up, all that glitters, gold. Rising today, set for its second straight week of gains. That took you back to elementary school. Well, for some of us. But can the commodity continue its hot streak? We'll discuss on the other side.
Interesting moves happening in the commodities markets. Oil is trading near its highest since late April and on track for a fourth straight week of gains. And gold is headed for back-to-back weekly gains. Scott Bauer is the CEO of Prosper Trading Academy. Scott, good to see you here after July 4th. Talk to us about gold. Are the fireworks just beginning in that commodity?
You know, it's all about the dollar and it's all about rates, and the trajectory with the weak eco data that we've received over, probably the last 4 to 8 weeks, the jobs number this morning as well. The trajectory has now been that the Fed is more than likely cutting in September. Personally, I think maybe they even need to consider July, though that's off the table for now pretty much. But the eco data has been weak. And gold has really followed, the path of the dollar in an inverse relationship. So to me, when we see how the dollar has hovered around 105 or so over the last weeks or so, to me, it has not been because of dollar strength. It's been because of other currency weakness. So now that we're starting to see, this eco data really get softer here, I really think that we're going to see a dollar that probably challenges 104 sooner rather than later. That's good for gold. That definitely has been some of the impetus as we're seeing gold really trying to attack those all-time highs again.
So, Scott, isn't this the most, I would say, a great place to hedge your bets? If you're concerned about the election, is gold right now the ultimate safe haven play?
I don't know what the ultimate is, but yes, it is a safe haven play, both from the risk off standpoint and quite frankly, from the dollar standpoint, from rates standpoint. Is there, potential downside? Of course there is. But I do think that gold is a great place to be here. If you look over the last year or so, and you saw the amount that central banks around the world were piling into gold and buying it and storing it, it's off the charts. It's unbelievable. So I really think that the downside potential as gold is a lot less than what the upside could be over the next 6 months or so.
Yeah, UBS had put that within their Election Watch 2024 as well, saying that they think gold represents an interesting opportunity, lifting their stance on the asset to most preferred, given some of the concerns about geopolitical polarization, inflation, U.S. fiscal deficit and whatnot. Scott, how high do you believe gold can go? If we're talking new all-time highs, what is the marker that you believe that it could move to and perhaps even through?
Well, that all-time high, we're about $80 away, $70 away. It's, $24.50-ish or so. If you look technically at the charts here, there's a pattern that could really take us up to 2,650, 2,700. I don't think we would get there that quickly, though. Listen, with all of the geopolitical risk out there and, the added risk around our election right now, or added, I should say, uncertainty around our election here, if we break those old highs here, there's really, from a technical standpoint, not a lot of resistance there. We could see a pretty quick move up.
Scott, how are you, outside of gold and commodities, how are you trading into the weekend? What trades do you have on? We have a president giving a very key interview at 8 p.m., has a couple campaign stops on Saturday and Sunday. Monday, you get the sense that something big could happen and you could see a lot more volatility in markets.
So I have been long and continue to be long, full disclosure here, some downside put spreads in SPY, in the Qs. I'm long some VIX upside calls. Obviously, those haven't really worked over the last several weeks or months, but something that I always discuss with my clients and something that I always, talk to people about is buying that insurance when it's cheap, right? We all want to go out and price our homeowners, our auto policy, our any insurance, and we want to get a bargain. We want to get it on sale. Protection is cheap right now in the marketplace, whether you go out a month, whether you're going out 6 months. So what I'm telling people is you want to stay in the market, you want to, capture this grinding move to the upside, fantastic. Buy the cheap protection, and if you have to give back, a little bit, 0.5%, 1%, whatever it is, fine. But there's this old trading adage of buy when you can and not when you have to. And what that means is once something happens to the market, once, as you just said, that we're maybe getting set up here for something to happen, it's too late. The cost has doubled, tripled. So buy that protection when you can. So that is how I am positioning. The day trading in the marketplace is fantastic right now. Even though it's summer, we're seeing some volatility in pockets. Overall, though, downside protection way too cheap, in my opinion.
Scott, great to see you. Thanks so much for joining us here on this Friday. Appreciate it.
Have a great weekend.
You too. Everyone, coming up, we have acting U.S. Secretary of Labor Julie Su joining us to discuss the June jobs report on the other side of the short break.
jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
With a rich history dating back to the 19th century, Eli Lilly has faced struggles and successes. But a booming market cap has quickly turned it into the biggest pharmaceutical brand in the world. Let's dive into Lilly's biggest moments with Beyond the Ticker. The company was founded in 1876 by Colonel Eli Lilly, a pharmaceutical chemist and Union Army veteran. Lilly experienced huge growth before and after World War I, including the expansion of its Indianapolis facility. In 1923, the company began selling Ileton to treat diabetes, the world's first commercial insulin product. Then in 1952, Lilly became a publicly traded company on the New York Stock Exchange. In 1971, Lilly acquired cosmetic brand Elizabeth Arden for $38 million, eventually turning it into a financial success. It sold Arden to Fabergé for $657 million in 1987. Fast forward to 2009, when Lilly faced a fine of over $1.4 billion, the largest in U.S. history, for illegally marketing its blockbuster mood disorder drug Zyprexa. It wasn't until 2022 that Lilly hit the jackpot with tirzepatide, a new type of GLP-1 product sold as Mounjaro for type 2 diabetes. It began competing with Novo Nordisk's Ozempic. Zepbound, the same formula as Mounjaro, was approved for obesity in 2023 and began competing with Novo's Wegovy. The tirzepatide drugs have spiked Lilly's stock by nearly 100% in the past year. In 2024, Lilly continues to reach all-time highs and is currently the biggest healthcare company in the world, with a market cap of well over $800 billion. Wall Street projects the GLP-1s alone will net Lilly $13 billion this year. It's why Lilly is on track to make history as the first trillion-dollar healthcare company.
Let's take a look at the markets. We're half an hour into the trading day almost, and taking a look at the Dow, the S&P 500, and the Nasdaq. The Dow has been trying to make up its mind here early in trade. As of right now, it is flat, but to the downside. We saw that kind of open up and try to ultimately figure out which way it did want to open. Ultimately was just basically flat is the way you want to summarize it here. S&P 500 though, flat to the upside. Nasdaq Composite seeing some fractional gains there, up by about 0.3%. As I'm taking a look at the Nasdaq 100 on the Wi-Fi Interactive here, Meta seems to be leading some of those Nasdaq gains on the day. That's up by about 2.2%. Nvidia is actually down by about 1.2%. Coming up, everyone, we've got Acting U.S. Secretary of Labor Julie Su joining us to discuss that June jobs report. Stick around. In the June jobs report, we saw unemployment tick higher, smidge there by about 0.1%, coming in at 4.1%, and ultimately wage growth a touch lower. So what does this tell us about the economy right now? We have Julie Su, the United States Acting Labor Secretary, joining us here on Yahoo Finance. Julie, great to see you here. First and foremost, just want to get your read in on what we're seeing in this labor economy and where there are areas that the White House still needs to consider doing even more work.
Another solid jobs report. 206,000 jobs created last month, bringing the total since President Biden's come into office to nearly 16 million. The unemployment rate remains at historic lows. It ticked up slightly to 4.1%. But remember, before this, it was at or below 4% for the longest stretch since Neil Armstrong stepped foot on the moon. We are looking at not just temporary improvements to our economy, but a national strategy that President Biden brings that has resulted in the most robust recovery from 2020 that could have been imagined. If you recall, on this day in 2020, under the last administration, the unemployment rate was nearly 12%. And there was no national strategy to address the economy or the global pandemic. President Biden came in with a national strategy. We've been implementing it. And of course, there's more work to do, right? We are not going to reverse decades of underinvestment in our nation's workers, in our nation's industries, in growing jobs overnight. But we're on the right track. We're making progress, and we'll keep at it.
Secretary, what do you say to those Americans that are going to see this report, probably likely over the weekend, and they're going to notice an uptick on the unemployment rate and job growth slowing down? Do they have reason to be concerned?
I don't think so. I mean, again, it is a very small uptick and it remains historically low. I think what American workers are seeing is investments in their communities. To the tune of $2 trillion under President Biden's Investing in America agenda. Roads and bridges being fixed, airports being modernized, clean drinking water coming out of faucets, high-speed, reliable internet being delivered, a commitment to addressing climate change. All of these are happening in communities, and what that's doing is creating good jobs. And our promise is that every worker who wants a good job should be able to get one. And when I travel the country in our Good Job Summer Tour, we're talking about the importance of a good job, what that means to a family, to a community, and why the president is so committed to making sure that everybody can have one.
The reality is with wages even, there's still so many in places here, like here in New York, where you can feel like you have a good job, but the wage still might leave you in what's classified or considered a poverty level. How are we seeing moderation and in a better scenario for a lot of people out there, how are we seeing wages continue to move higher and outpace inflation? Because that is a concern for many households.
Yeah, it's such a good point. So real wages have outpaced inflation under President Biden. Again, that is not an accident. That was not inevitable. It's because the president understands that we both need to create a lot of jobs and we need to make sure they're good jobs. Good jobs, meaning somebody can make a living wage, support a family, put a little bit away for retirement. As he always says, so you can look your children in the eye, tell them everything's going to be okay, and mean it. So the actual quality of the jobs that we're creating are very different. We're focused on ensuring that people have benefits so they can go to the doctor when they're sick, that there's some real security. And when I travel the country and see people entering a community college in order to get a skill to do a manufacturing job that did not exist before, or in an apprenticeship program to help build up their own community, I see that hope and security that only comes from a good job. And we need to keep on doubling down on those investments. And that's why we need to keep up the work that we are doing.
Secretary, this jobs report comes against a challenging period for the president, a couple of key moments coming up for him over the next few days. A lot of Americans are concerned about the president's ability to continue in this role over the next few years should he win re-election. You've worked closely with the president. Are there concerns well placed about his ability to do this job?
I don't think those concerns are well placed at all. I will say I was just with him earlier this week. We announced the first nationwide standard to protect workers from heat. You know, it's hot out here. Everybody knows it. For workers, heat is not just an inconvenience. It's not just a discomfort. It can be a workplace hazard. And nobody should have to be afraid that they're going to die on the job because it's too hot, when we can do simple things like shade, like rest, like water. And those are things that are in the first national standard that got done because the president said to me last year, what are we doing to make sure that those workers are protected? You know, you're asking what I'm concerned about. I have the same concerns that the president has. I want to make sure that workers get a fair shake. I want to make sure that we continue to combat the massive gap between CEO pay and frontline worker pay, where CEOs make in a week what workers cannot make working several years. We want to bring down the cost of prescription drugs and relieve student loan debt so that people can look into the future with hope. We fought for retirement security. We're putting more money into workers' pockets. Just this past week, 1 million workers got eligible for overtime pay because of this president's economic policies. So I share his concerns that this economy needs to work better for working people, needs to make sure that it leaves no one behind, and that's the work that we are very focused on, making sure that we reverse decades in which this was not the policy.
And so as President Biden has listened to working class families and households and tried to do and put forth those efforts that you just ran down the list of, if those same households are expressing concern about the president's ability for another 4 years to do a very high demanding job, what do you believe the talk would be and the calculus in that instance?
I mean, again, what I hear from American workers when I travel is they are grateful that they have a president who finally sees them, who finally understands them, a president that walked the picket line the first time ever in history, a president who supports their right to organize, and we're seeing historic gains for working people, higher wages, benefits, the right to join a union. Again, those are fundamental. Our president is called Union Joe for a reason, and he understands that when unions do well, the middle class is stronger, we build more pathways for people to feel a sense of security. That is what we are doing, and I know from traveling that that is what people see, and again, we have to continue to deliver, and that is why we're on the right path, but we're not finished yet. In fact, we're really just getting started.
Julie Su, the United States Acting Labor Secretary, thanks for always making time for Yahoo Finance. We appreciate it. Have a good weekend.
Thank you. It's always great to be with you.
Thank you. Coming up, we dive deeper into the June jobs report on Catalyst. Straight ahead.
It is just after 10 a.m. here in New York City. I'm Brad Smith, still alongside Brian Sazi, and Miles Udlin is joining the action now as well at the desk. It's almost like our viewers tweeted in and said, there are not enough rows in this show.
That's
Get
right.
more. All right, well, we're all here and locked and loaded for you guys. Let's dive into the catalysts moving markets today.
All right, I got some catalysts for you. The labor market continues to moderate as June non-farm payrolls came in below the average monthly gain and unemployment ticked higher. Could the slowdown in hiring be the catalyst the Fed needs to slash interest rates in September? I know you like that, Miles.
Well, speaking of labor, UK stocks rally as Britain's Labour Party unseats the Conservatives after 14 years leading the British Parliament. We'll discuss the impact on potential global markets coming up later in the hour.
Plus, it's a critical weekend for President Biden as wealthy Democratic donors say they will pull funding if he does not drop out of the race. We'll discuss the critical weekend ahead for Biden's campaign.
But first, we have to dive into this June jobs report. 206,000 jobs, a little bit above expectations. Goldman Sachs very wrong, looking for 140,000 increase. Miles, you've been digesting these numbers all morning long. What do you think this means to what the Fed may or may not do on rate cuts?
Yeah, I mean, the pressure to cut rates in September is clearly building, and it is really starting to feel like when the Fed meets in, 4 weeks from now, at the end of July, they're going to set the table for a September rate cut. And I was looking at, so the unemployment rate is obviously the real headline here. We see highest unemployment rate since November 2021. And I think if we look at the dot plot from June. So this is Fed forecast. We've talked for weeks now. Fed forecast suggests one rate cut in 2024. And that's true, but if you look at the way the dots broke, you actually have a plurality of Fed officials, 8 Fed officials looking for 2 rate cuts in 2024. The real change is that you had 4 officials in June now looking for no rate cuts. And I think what we really see in this cluster of dots for 2024, it's probably not too much of a challenge for Jay Powell to get the Fed on board. And for Fed officials, over the next several weeks, we will have the Jackson Hole Symposium at the end of August, another crucial time for Powell to set the table for policy changes. It's not going to be, in my view, super challenging for Powell to get the rest of the Fed on board with the idea that it needs to be a 25 basis point rate cut in September, and probably again in December. They'll buy themselves some time to see how the fall plays out, election, etc. But it is starting to feel like it's less and less tenable for the Fed to not act when September rolls around.
Yeah, I mean, look, I'm going to pull up this dot plot at my next barbecue and see how many people.
I did it yesterday. That's why the party was so great.
I mean, I know it was ripping to the upside, especially if you have one of those.
I was looking at Nvidia stock charts, man.
But at the end of the day, a lot of people just want to figure out, when am I going to actually feel better here with the inflation that I feel like I'm paying more for in grocery stores, where I'm also looking across job prospects and those being available, and at the right wage to offset where inflation is persistent in the services part of the equation for themselves too.
Well, if we keep it in like markets talk, right? I think economists are circling the idea the Fed is now behind the curve.
Yeah.
Or is looking at being behind the curve. Meaning, to your question, Brad, a lot of that stuff, that horse has left the barn. We know the job market is tougher out there. And it does feel anecdotally like 4.1% understates the tension or, kind of the looseness within the labor market.
Despite it being normal.
Despite it being normal, I think there are a lot of folks who, especially a certain class of worker, it's like you're on LinkedIn, you're talking to people, and it's like, quote unquote, no one can find a job right now. It's not entirely true, but it feels like it's tighter, or looser rather, I keep mixing that up, than a 4.1% unemployment rate. And it feels like this notion of, housing costs will get under control, inflation will get under control. It feels like that's over. It feels like we're all like, not a great vibe out there in the economy. And I think that's where the Fed is going to feel some pressure to act now, because the softening is starting to look a lot clearer.
Okay. Absolutely. All right, let's bring in our next guest for more on the latest jobs numbers. Beata Manthi is the Citi Global Equity Strategist. Beata, thanks so much for joining us this morning. I want to get your read in on what we're seeing more largely here on the trend of economic data that's coming in.
So Citi economists have been highlighting for quite some time this underlying weakness in the labor market, so under the surface weakness. And this is starting to play out and be visible in the coming data, especially today. And what that means is there is a silver lining, and Citi economists' view is that we are indeed going to get the first cut out of the Fed this coming September.
Yeah, how many rate cuts are you expecting from the Fed this year?
So we are above consensus there. We have, Citi economists for the US have 3 cuts starting in September.
So your expectation is that inflation from here will continue to slow in large part because of continued slowing job growth?
Correct. So inflation is slowing down. The underlying weakness in the labor market is starting to show up. The Fed has a dual mandate and they are going to act on it.
With that in mind, as we're taking a look at the probability for a September cut, I mean, what as we're, looking past almost this year, because now we've gotten from 6 or 7 cuts that we were talking about coming into this year down to 1, maybe 2. What does that set up for 2025?
That's a good question. Remains to be seen. We see continuation of cuts into the next year. But of course, as you've mentioned, the market has been changing its mind a lot this year and has been quite data dependent. So remains to be seen. We see more cuts coming through in the next year as well.
Beata, you are a global equity strategist, so I would love to go a little bit more global with this conversation. We got to get your reaction to the UK election results. Prime Minister tendered his resignation this morning to King Charles. What can we expect from a majority Labour parliament?
So I'm most of all European equity strategist, so I can tell you much more in detail about what it means for equities. So in terms of the election, very widely anticipated outcome. What you need to know about it, that it's a more business-friendly Labour Party that we are having right now. And in terms of what it means for the equity markets, it's really going to play out, number 1, through rates, and number 2, through sterling. So in terms of growth and our view on FTSE 100 or MSCI UK, we are more bullish on other markets than this particular one. However, within the UK, our preferred election trade is FTSE 250 versus 100, or small and medium-sized stocks versus large-sized stocks. So they are more exposed to local economy. They are better positioned to benefit from the rate cuts that are coming through perhaps as soon as August from Bank of England. They are more exposed in a positive way to potential strength in the pound that we see in the short term. And also what is very important is that they have derated a lot versus large caps or FTSE 100 over the past 2 years. They are down. They underperformed 25% since the peak in 2001, underperformed year to date, and they are actually showing a superior EPS growth, double the one for FTSE 100 or the larger caps. So that's our preferred trade in the post-election world for the UK.
For those U.S. investors concerned about volatility ahead of the election, and they don't want to play Europe because Europe is growing very slowly and it's unclear when the ECB may come across with another rate cut, are there emerging markets that U.S. investors could look to for potential alpha?
So in terms of our global allocation, we are right now overweight the US market, which we have recently upgraded to overweight immediately in the aftermath of this snap election announced in France, downgraded continental Europe to neutral. Emerging markets are already neutral, but within emerging markets, those countries that we like the most are Taiwan, Korea, and India.
Appreciate the insight. Beata Amante, Citi Global Equity Strategist. Good to see you. Have a good weekend.
Likewise.
Turning to retail, the parent company of Saks Fifth Avenue, HBC, says it will acquire Neiman Marcus Group in a $2.65 billion deal. I mean, I want to be more excited about this, but I think this has been, and I've talked to Mark Metrick before, I think he has been working on this for some time, so this was largely to be expected. But it comes against a backdrop of a department store space that continues to fall apart. You have Macy's closing hundreds of stores. And I think this is ultimately a play, I think, on the e-commerce business for these companies, and then maybe for the off-price business.
Well, I was going to ask you, Saz, what is the future of the department store business? like in general?
I mean, I think Macy's is giving you a taste of it. It is probably you have 200 to 300 stores open in A locations, the best of the best, and everything else just doesn't exist anymore.
But then
It's just all online.
It just is online.
Okay, that was going to the follow-up though, is like, is there a combined e-commerce business here? And I say it because I find myself as a consumer, and I think the businesses find this as well, everyone has, pretty much everyone. Now they would say some of the luxury houses they play with maybe don't have an e-commerce presence, but pretty much everyone does. And I usually have a general idea of what I want, and let's call it e-commerce warehouse type websites, even the ex-Amazon division, it's not the most pleasant experience. Like browsing through a variety of brands, I don't really know what I'm getting. So if I'm at a combined Saks Neiman website, I'm gonna see some brand. I would probably rather go to that brand's website and figure it out for myself there. It's more coherent inside of a brand.
That's why the ultimate play here is a Louis Vuitton that is well off its highs. This is a brand that has been able to control their own destiny. They're opening shops. You want Louis Vuitton, you go to a Louis Vuitton store and get that full-on experience. It's just a better experience.
Well, here's the thing. The reason that department stores, to your point, did so well was because people didn't know what they want. So what's become the kind of modern day resolution for that for retailers online? It's inferential technology, artificial intelligence in some cases, that tells you what you want and essentially takes your purchase history and is able to aggregate enough information around you to suggest, hey, you're either running low on this, or this is where we're going to generate demand in another part of your home or in your lifestyle. And then on top of that, the mall was successful because of traffic. Traffic has shifted to go online, or the new mall is essentially on your Instagram app where you're just searching through there and you get a bunch of ads that get thrown in front of you as if you were walking through a mall and having that discovery process taking place in a virtual concept instead.
Yeah, and I think we talk a lot about our own data and the integrity of our data, where it goes. Yeah. But to your point, Brad, I think I've made peace at least, and I think a lot of people have. Okay, Instagram knows pretty much everything about me. Guess what? Over time, they'll probably target me something that I will eventually buy. I'll be like, you know what? I do like that. I did want that exactly, and that's fine.
You would appreciate, I think, the nuance on this one. I think the story here is Amazon being a minority investor in this combined company. They're not only an investor, but they're also focused on logistics. If I'm a UPS and FedEx, I'm looking at this, I'm like, wow, Amazon is really playing ball in logistics right now.
Well, the subtext, it's a whole different conversation that we don't have time for, but the whole subtext of what do you do with these combined e-commerce storefronts? The Amazon experience has plenty of problems that we could go for hours about, and I wonder how the current team, with all the AI pressures, what's going on at AWS, what they do with the retail piece going forward to make that just like a more Amazon experience. I mean, there's plenty of good things about it, but there are plenty of things about going on Amazon and a lot of other, warehouse type e-commerce sites these days that is not the greatest thing that I've ever experienced.
No, well said. All right, coming up, we'll take a look at a few of the trending tickers on Yahoo Finance. Stay tuned. You're watching Catalyst. Shares of Tesla in the green this morning, continuing its comeback after second quarter deliveries beat analyst estimates earlier this week. Shares are up over 20% for the past 5 days. And it's just only in Tesla land, guys, you'll see a company show declining deliveries, and this is an embraced set of results. I think a lot of the folks right now are just afraid to be short this name into that August 8th robotaxi event.
Well, also the stock was down 40% year to date at its lows in mid-April. So if you were short coming into this year, I think there's probably a, hey, we don't need to press our bets anymore at this point. And as I've been looking at this, rally, because Inez Ferre has written 3 days in a row now a Tesla story for us, and the story is kind of just like, the stock keeps going up, because you know what? It's worth letting people know, hey, stock's still going up. And I'm wondering if there is not look at what happened with XAI. They raised a bunch of money. There's some bullishness about the general Elon-verse. If that's not a part of, the meme part of the Tesla stock as, the purest play on Elon Musk. If things in general for Elon Musk's business interests are looking up, Tesla is the place that you can express that most easily as an investor or as an individual investor who, does not have access to things like a SpaceX secondary.
Well, let's remind folks too. I mean, he is disappointed at some of these events. They had an energy storage event. He let people down. I think the stock got hit too. So there's no guarantee that come August 8th, Elon's going to come out with this mind-blowing Uber rival that's going to instantly take market share in under a year. Right?
If history is any guide, he won't.
He won't.
What targets has he met? The Cybertruck, even when it did come out, lackluster on actually meeting what was promised going into the launch of that.
I saw my first Cybertruck yesterday. I actually I saw it, but I actually touched it. I touched the side. It was pretty cool. It was a good moment.
What was the texture?
It's big. It's just smooth. It's weird. It's too big. It's too big. It's too big. It can't fit this thing anywhere.
It's clunky on the road.
They are very big. But the stock is now making its way back towards break even for the year.
Yeah.
So look, you can kind of hack up the time frame with Tesla at any point in time and find a good or bad story.
Well, the robotaxi was supposed to come out in 2020. I mean, this entire fleet was supposed to be something that happened 4 years ago. Now you can give them a little bit of grace, I guess, because of the pandemic.
Yeah.
But then, at what point do you say, okay, you guys promised us this by 2020? We'll give you 1 year, 2 year grace period?
I just feel like you cannot, if you're in this thing, you cannot earnestly sit there and be like, Elon is disappointing me again. It's like that story is so well baked. You are just making a long-term bet on Elon's vision and the deliverables meeting these certain timelines.
Yeah.
That is stuff for stiffs to talk about. I mean, I just don't think that can really be part of it. You have to have made peace with that already, because it's 2024. He's been at it with this company now for 15, 16 years. So.
Been at it with everybody too. SEC, his own investors.
Oh, there's folks on the internet.
Yeah, exactly. One part of the internet that he owns too.
That's right.
We're also looking at Apple this morning because we're always looking at Apple.
Always.
Evercore ISI reiterating their buy rating and a $250 price target on the stock. The firm saying the company had another good month for the iPhone. You're taking a look at shares up by about 1.5% right now. Okay, so another good month for Apple. I think it's going to be a larger question though of how many people are waiting to get into the new iPhone because of the promises that they were making at WWDC? Is generative AI enough of a demand generation driver for Apple in the next inflection
Well, this
point?
data is pretty compelling. Shipment data up in May, according to Evercore ISI, 40% year over year, coming off a growth rate of 52% in April. That's good, suggesting that this acceleration is easing concerns about Apple's position in China. I mean, China has been just a weak spot for Apple, at least for the past several quarters.
I was reading this note, and I was thinking about another note we saw from Mike Kantrowitz on Wednesday about he doesn't want to talk about the S&P anymore. And because the S&P is all AI, right? And I'm reading this note, and it's like, okay, we want to do the AI iPhone upgrade super cycle. But go back in time a few months, the story was Apple's not playing in AI.
They're totally irrelevant.
That's why the stock is lagging.
Irrelevant.
And you sort of wonder, if we start to sour on the AI theme even a little bit in the second half of this year, wouldn't it be great for Apple to just go back to talking about regular iPhone sales in China, in its biggest growth market, and they don't have to worry about AI? They make a ton of money, they pay a dividend, they buy back a ton of stock. It's a safe place as an investor to say, hey, we're overweight Apple. It was not very fun to say that a few months ago because there, again, was not, quote unquote, an AI play. That story, obviously we've seen the stock chart, since late April has really turned around. But being a more conservative entrant within that field and just getting back to the basics of selling a lot of people, a lot of iPhones, and a lot of services related to the iOS system maybe that's the best play for Apple.
Yeah, who are we to argue with Warren Buffett? I mean, big time holder in Apple. Guy knows a thing or two.
Well, somebody else executed the trade. He probably just had to sign off on it. But, at the end of the day, for Apple, if you go back in the annals of history, there are never going to be kind of over the past 2 decades instances where you look at Apple and say they were a first mover in putting technological innovation out there. They see what the market demand profile looks like. They get a sense of what the fair pricing that consumers who have already bought into their ecosystem would be comfortable with, and then maybe say, well, over time, we might be able to charge a little bit more.
Yeah.
But they've never been, especially under Tim Cook, never been the one to say, okay, we're going to be first in MP3 players, or at least that was back when he was CEO, or COO, excuse me. We're not going to be the first ones to be, fully touchscreen phone, even under Jobs at that point. There were other instances of innovation where companies beat them to that, and generative AI is another instance where they're being extremely calculated, and I think that's where we didn't hear from them for months, almost a year essentially, on the generative AI front, so that they could be conservative to your point, but calculated as well.
Yeah, I mean, and you go all the way back to the jobs report today. If the economy is entering a different phase and markets are entering a different phase, isn't it better for you to have a better core business to talk about rather than to say our story is playing in the next gen of tech? Because rates are high, the situation for your core customer base, regardless of what business you're in, is going to be changing. Isn't it just better for Apple to say, we're all got our Macs on the table and our iPhones on the table?
Well, Julie Sue says the job market's going to stay hot, so she's good.
Well, we'll see. We'll see. All right. Let's talk a little bit about what is in our closets. Let's play a fun little game called In or Out, and we're going to talk about 3 retail names that I know the 3 of us all have plenty of exposure to: Nike, Lulu, and Deckers. Let's start with Nike, and you take it any direction you want. Brad, I'll start with you. Nike.
Oh boy.
Are we in or out?
I'm still in.
Okay.
And are we talking in my closet, or are we talking?
However you want to interpret it. However you want to interpret it. The stock, the logo, anything.
Yeah, the iconic swoosh. Are you done with it?
This year's Olympic uniforms.
Yeah, so I think for Nike, there are a few things that are alarms for some consumers, some investors out there even, and we'll get to the dunks that you're seeing on the screen because that's a large portion of it. We've been speaking quarter after quarter, especially with Adrian Yee of Barclays, about what needs to happen at Nike, and I wrote up a story earlier this year that still holds true from Adrian and our conversation, talking about they need more innovation. Mm-hmm. This company needs more innovation. You think about the number of brands that are doing really well at taking market share on the apparel side, purely because they're able to tap into audience bases that listen to Nike, but also listen to them over platforms like social media. They see all their friends wearing a Gymshark. They see all their friends wearing ALO or ALO. I don't even know how we're pronouncing it. Great. So I was 0 for 2.
Fiore.
So all of these new players have entered into the space, challenged the behemoths that Nike, Adidas, Lululemon even, and I know we'll get to them, that they are, and ultimately put pressure on them to say, okay, now you have to out-innovate these new smaller players that are either more ESG minded, that are perhaps even more creative in how they're marketing, and go after that same consumer, and on a pricing perspective, figure out a way to make sure that as consumers are looking at this discretionary purchase, that they're either going to buy into a Jordan shoe that they bought back in '96, and once again here in 2024, or if they're going to wait for something else that's actually worth the $200.
Taz?
I'm very simple. I'm Richard Nixon out. I'm piecing out of Nike.
Out.
I'm out on Nike, and my thesis is very simple. One, I think CEO John Donahoe has done a terrible job. And I think it's his time to announce a successor. There has been some chatter that you will get the next CEO of Nike coming up within the next year, as should happen. I think he's disappointed investors for the past 4 quarters in terms of results and guidance. The street does not like to see this. And I think John has held onto this job for too long. Number 2, China. I think the inventory levels in China remain too high. The sales results and operating margins in China remain under pressure. And these things for a business the size of Nike does not change overnight. Companies probably looking at 2-3 more challenging quarters in China before they course correct. So until I see some form of who the successor is for the CEO role at Nike and better results at China, I can't be in this name.
Just a stat real quick. Toss up those panda dunks once again here, because I got one.
You're going to stay in. You're just going to stay in just because you're in.
I want to talk about my own footwear, but Brad, continue.
#1 selling sneaker on GOAT and Flight Club. #1 most wanted shoe on GOAT for the 2nd straight year in a row last year in 2023. Average profit margin when it's sold on those platforms, 33%. People were buying into something that came out back in the 80s. again, and for higher profit margins, higher markups here. So that's both a gift and a curse.
I want to know, John Dono, tell me why my new Nike Maxes are peeling. I want to know. I just got them and they're peeling and they're garbage.
So I did like everybody else, 18, 19, was like, I need sneakers, right? Yeah. It's the cool thing to do. And so I had 4 pairs of ones that I thought were sweet. And I wore a pair to the office like a month ago, and I'm like standing there and I'm looking at my feet. I'm like, what am I doing? I am a father. This is not cool. Like, this is out.
Get a pair of Skechers.
And it just doesn't feel like it, right? Speaking of it, let's talk about Lululemon. We mentioned Vuori before, so I know they are selling footwear, maybe more of an apparel play. Brian Sazi, are you in or out on Lulu?
Staying with Richard Nixon.
This guy's out.
I am piecing out on Lululemon, and this is very, very simple. If you go into Lululemon's latest 10Q, keyword the word conversion. In the most recent quarter, there was something that happened in Lululemon that I have not seen in some time. It's a major red flag. Conversion rates were down. What does that mean? You go to a store, you leave with nothing because their clothes stink. I think this company is having problems with color, fit. They've lost key executive talent. So until I see better conversion rates from Lululemon, usually it takes 2 or 3 quarters to course correct that. I can't be in this name either.
Bradley?
I mean, the competitive advantage for a while you saw that stock rising back a couple months ago, and now the retreat that we've seen is because consumers are recognizing that they can get the same fabric at different stores for lower prices, and it's uncreative right now. I mean, it's just colors on clothes.
Yeah, it does feel when I walk into my local Lululemon, of course I have a local, that it's kind of the same thing. Just sort of reskinned. Yes. Now, I will say I'm still in. I'm still in on Lulu because
why?
The clothes do hold up a lot better than other brands that I've owned.
Great clothes.
And for my needs, which is basically feeling not like a working stiff like I'm seated right now, it always meets my needs. And I think the durability for my closet has played out over time. And maybe this is the problem for the stock. Me, a boring dad who's like, I just kind of want the same thing. It is still kind of the same thing. So this is not great. That's why the stock's down 40%. Not great for investors, not great for the story, but as a core customer, I'm still in. I'm not really shopping around for alternatives like an Alo or like a Vuori, even though both those stores are now just down the mall aisle from.
I know we gotta get to Omar Miles. I was sitting around at the barbecue yesterday, a bunch of 50-plus-year-old dads. They're all talking about their new Skechers shoes. You gotta get, they have the slip-ons, they have the cushioning, about $40, $45 get you into these. It could be time.
My father wears Skechers, so
they're really good.
You won't be finding me.
They're really comfortable.
You know what else my father wears? He wears Hokas. So let's talk about Deckers Outdoors. Deckers Outdoors. Really, the story here is Hoka. The changes that have happened in the technical running footwear space of the last 10 years, I would love to do a whole show on. Brian, are we in or out on Hokas? I know you had Ons on the other day. Where are we at with the big guys?
I am
chunky boys at Hoka.
I am also out on Hoka.
He doesn't like anything.
Hoka, the
what do you
stop
wear?
button.
What's he in on?
Look,
it's all the dress shoes.
All the growth rate. I like the shoes.
On.
I like the UGG story, like all those things. I am concerned just from a pure stock perspective.
It has been a monster.
And the growth rates have started to slow. Even for Hoka, this was a brand a year ago growing at about 100% year over year. Now it's down about 30, 40%
they are
growth.
Everywhere.
When you're a growth stock and your growth is slowing, usually not a great setup.
I'm in on Deckers for a different reason, though, for Uggs. Uggs, for some reason, continue to be like the thing that...
Do you have Uggs?
I don't, but I know too many people that do in this day and age, and I just can't figure it out, honestly. Even
they're so soft. The men's slippers, Brad.
The slippers are great.
They're so just the fur.
Right. Is it fur?
It's like what is that?
I don't know.
It just suits your foot so nice. It's just so nice.
Yeah. It could be alpaca for all I know. Like at the end of the day, I just know I see a lot of people wearing them. Yeah. So. For some reason, they were popular back when I was in middle school, and everybody was just like, okay, we're going to make that cool again. Gen Z is really doing a number on us these days.
So I would say on balance here, it feels like some of the bigger public names in the athletic apparel space. We didn't talk about On, which is sort of the one we didn't, in Adidas. It feels like we were mostly out.
I'm concerned that I now see On the feet of older folks and uncool people. That was usually a telltale sign.
Hey, you know who just bought? Who just bought Ons? This guy.
I didn't. Well, I can't see you as an On guy.
This is the worst part. There's one model they have, and I've had a few pair. I get like one pair a year, and I had to refresh.
Huh. Okay.
But it's
the Cloud Monsters.
No, it's the Cloud Nova.
Yeah.
Cloud Nova.
They make great shoes.
Wear down that
But
quickly.
I'm just
that you
worried.
need
Like,
to
I'm
get them
seeing
once
them
a year.
everywhere now.
They are not the most durable shoes.
No, they're
That's
not.
what I've heard.
No.
They're not the most durable
issue that
shoes.
I've
Shoelaces, no good.
So,
no good.
They don't
Alrighty.
crease at the right spot.
Okay, one bonus one here. In or out, Mark Zuckerberg, his celebration
Let's
of
see
the
it.
4th of July holiday.
Oh, I'm in.
No.
That is, I'm in for that.
Heck no.
I think that shows the power of Meta's AI, and I'm bullish.
I'm hoping an orca absolutely comes and capsizes his surfboard like they do those boats.
I'm assuming he's in Hawaii. He has a big spread out there. So this is one of the richest men in the world in a tuxedo, drinking a beer on I think he powers this thing with his legs, I believe is the story. Like you kind of like
isn't him.
pump it and it goes. Doesn't have a motor.
This is not
And he
him.
has an American flag.
No, this is not him. I thought it was like AI.
It's got to be
that's
AI.
him.
Really?
Him?
I think that's him.
Where are the security
time I've
guards?
seen
How are we
Although
letting this guy in the middle of an
I
ocean?
suppose it would be a great way to show off the AI capabilities, but I do think that's him.
Yeah.
It's something that he would do.
I think I'm
He's
in
got
on
his
it.
hokas on the beach.
I
It's
think
actually a Lululemon suit that
I
he's
think
wearing.
what Zuck is speaking to in this, and it has obviously plenty of upsides and downsides. We'd see it with a few other people. Elon Musk is in here. People say, what would you do if you had all the money in the world? How would you spend your time? The answer is usually I'd post more on the internet. That's basically what he's doing with his time. He is now like, I have all this money, I control this company, I will post what I want when I want, and I'm gonna have fun with it, and I guess good for him for having fun.
Was this from his Hawaiian compound that people were upset with him for buying?
I don't know the location. I assumed it was Hawaii because he has that spread. Although, he also has a place in California where the company is based. You could be in the water there.
Oh, just keep
but
showing.
It
I love it.
feels,
Just show it.
Northern California doesn't feel like I'm gonna go out and hang out on a.
Is that a high noon?
Is
that a beer or a high noon? Is that a high noon?
I think it's a beer.
It's actually that same caffeine
I
drink
think
that you have in your cup.
I think it's a pounder. It looks like a large can, so I don't think it's a high noon.
All right.
Love.
Really, the best part of high noon is the can.
Great thing to see.
The can form factor.
If you're a Meta shareholder, this is good stuff.
That's the balance you want.
What, yeah, do we know what the stock is up today?
You didn't ask us that. You asked us what we
How
thought
are
about the
investors digesting this?
They're sending it higher by about 3%.
There you go.
Leading performer in the Nasdaq 100 right now, Meta. All right, Miles, Sas, thanks so much.
Yeah, happy to be here. Great here.
Guys, coming up, we're taking a deep dive into the currency market. That is next on Catalyst.
I'm Richard Nixon out. I'm peacing out of
Blind
Nike.
out.
I'm out on Nike, and my thesis is simple. I'm Richard Nixon.
Hey, welcome back to Catalyst. I'm joined now by Yahoo Finance's Inez Ferre. Inez, thanks so much for joining us on the desk here. Let's dive in to the currency market for this next conversation. The U.S. dollar is edging slightly lower after the U.S. added more jobs than expected in June. For more on this, we have Jane Foley, who's the head of FX strategy at Rabobank. Great to have you here with us this morning. First and foremost, I want to get your reaction to what we saw come through in that piece of economic data and why we might be seeing this type of reaction, what the typical kind of nature of and correlation to the dollar and the employment report is.
Well, first of all, thank you for having me. But this wasn't necessarily all about that headline number. It was about what else came within that report, and particularly the revisions. So we saw a significant downward revision to the last 2 months worth of payrolls data, meaning that a month ago when we were here, staring at what we thought was a very, very strong payrolls report that month, well, actually it wasn't as strong as we thought. And so in addition to that downward revision, we also got a tick up in the unemployment rate. And I think put that all together, and you can say, yes, you know what, we got a report which perhaps went into the same sort of way as the economic data that we had earlier that the week was suggesting, which is a cooling in the US labor market. Certainly not one that is falling out of bed, but certainly one that is cooling. And that only served to just reinforce some of that excitement that had built during the course of this week that, yes, you know what, a Fed interest rate cut in September and then maybe even later in the year as well is certainly, a primary risk.
Certainly. And how many cuts are you pricing in from your own purview?
Well, here at Rabobank, it's 2, which I presume isn't too far away from a market consensus. So a September interest rate cut and probably another one in December. But that said, all economists, in addition to, the Fed policymakers, are still going to be looking at forthcoming economic data to get further justification for those sorts of forecasts. I think so far, the data that we had this week, the ISM numbers, that the labor data that we had today, that the labor sub-index of the ISM data all point to the prospects that, yes, that the economy is slowing down sufficiently to bring that interest rate cut. But again, you look at that prices paid subsector of the ISM, it's still quite sticky. So, there are still elements here with respect to inflation and particularly services sector inflation that policymakers are still going to be a little bit concerned about.
Jane, I wanted to get your take on the Labour Party win in the UK and the movement that we've seen with the British pound against the dollar, the euro against the dollar as well. What's your take?
Well, if we look at cable, well, yeah, that has done pretty well. In fact, sterling right now is the best performing currency over the last 24 hours or so. The dollar, of course, is weakened by itself over the last few sessions as the market looks ahead to the possibility of a September interest rate cut. But sterling has done well. I mean, the gains that we saw today weren't great. They were fairly moderate. But actually, sterling is now the best performing G10 currency in the year to date. And that doesn't mean it's a strong currency, but it does mean that it is improving really from a very low base that we had back in September 2022 when we had, Trussonomics and the gilt market really worried about what that Prime Minister may do. Now, Liz Truss, today lost her seat. And we have, of course, an awful lot of headlines telling us that we've now got a landslide victory for the Labour Party. Now, that, of course, is true. But if you dig a little bit deeper into the data, perhaps you see something not quite so encouraging for the Labour Party. Now, in the UK, we have a first past the post system, but Labour managed to pick up this majority of seats by only getting a very small increase in the national share of votes, because what it appears has happened is that voters that previously had voted for the Tory party haven't necessarily all migrated to Labour, but they've gone to smaller parties instead, meaning that Labour hasn't really picked up an awful lot more votes this time round. And that suggests it's going to have to deliver on growth and productivity and people's incomes if it really is going to win the election next time around.
And the euro edging higher with the next round of voting in the French election taking place this weekend as well. What are you anticipating there?
Well, I think that's a lot more interesting, perhaps, than the UK election. Now, the market has been encouraged. Euro certainly moving up as polls come out that the far right, Le Pen's far right party, is unlikely to win a majority. Now, from the market's point of view, a hung parliament is better than a majority for the far right. But, it's very difficult to celebrate a hung parliament, because if we think about France's budget position, it's not great. The budget deficit in France is 5.5% of GDP. Brussels has wrapped France on the knuckles, along with Italy and 6 other EU countries earlier, just about 2 or 3 weeks ago, for not doing enough really to curtail their budget deficit. And when you have a hung parliament, you may not have the far right enacting some of their policies, but it's going to be tough to try and get that budget deficit in. A lot of the far right policies, things like wanting to reduce the retirement age, could be expensive. A lot of the policies of the left wing alliance, which is second after the far right in this election, are also potentially going to cost France more money. So it could be quite difficult to get that budget deficit in, and that probably means that as we go into the second half of this year, we could be increasingly worried about some of the budgetary positions of countries such as France and maybe Italy too.
Jane Foley, thank you so much for taking the time here with us today. Head of FX Strategy over at Rabobank, Jane Foley. Thanks. Coming up, President Biden facing more and more pressure to drop out of the presidential race. What his decision could mean for markets. Next. President Biden facing ongoing pressure from within his own party and beyond to bow out of November's election after last Thursday's debate performance, with many calling into question his mental fitness for another 4 years in office. For more on the president's future, let's bring in Terry Haynes, Pangea Policy founder here. Terry, what are your anticipations going into this weekend, knowing that there's a big interview that President Biden is going to be doing where the Americans will have another opportunity to assess the acuity?
Well, thanks for having me. I said right after the debate last week that I didn't think the president would get out for a very simple reason. You don't try to become president for 50 years and then chuck it after one debate performance. But now he's in a situation where, he doesn't have 3 strikes and you're out. He's already had 1 strike. He gets 1 more. So every day between now and the election, he's either going to have to convince people, the regular voters, that as well as the party grandees and fundraisers and the like, the regular voters, that he's up to the task and he's able to actually carry this thing off and win it. Otherwise, he's going to be gone pretty quickly.
What do you make of the number of big money donors that are shifting how they're prioritizing their giving to the Democratic Party and specifically to the Biden campaign, with this question mark kind of looming large over this weekend?
Look, in politics, as in many other professions, the motivations have a whole lot more selfish than you'd think, and I think that's what's going on with a lot of these donors who have already put up a substantial amount of money, have pledged a little bit more, and are in a situation where they're threatening, as you say, to repurpose or whatever. But the fundraisers always think they have an outsized impact on the political machinations on the inside, and they're not able, I don't think, to affect the result much. They can provide a little extra push if it comes to that, but they're not in control.
Terry, you're currently in London. What's your reaction to yesterday's UK election results with Labour taking over in the next government? And what would happen if Trump were to win the presidency, or if Biden or another Democrat were to win?
Well, the election is an interesting one of a landslide with no mandate. Jane Foley was talking about this a little bit, but I'll give you kind of a slightly different look for it. Labour won about 2/3 of the seats in the Commons, yet had a 35% vote share. And first past the post really means, for American audiences, really means nothing different than what we have. But what you had in the Commons elections were 3 or 4 or sometimes even 5 political parties going at it for each individual seat. So you get a situation where Labour's seat totals are pushed up because the opposition votes split between the Conservatives and Reform, let's say. Similarly, Conservatives lost an outsized number of seats, frankly, because of Reform. And you've got 2 political parties, the Lib Dems with their best ever showing, and you've got this new Reform Party with 4 seats, even though they got 15% of the vote. But what you see here is not a mandate for Labor or Labor's policies, but frankly, a situation where there's disgust and dissatisfaction with conventional politics as it's been practiced in the UK. Now, finally, what Starmer's going to have to do is proceed cautiously and, frankly, bring the country along with him. So, you're not going to see Labor jump in here and all of a sudden start wildly taxing people, the way a prior government might have done, because that's just not going to wash with people. They've worked very hard to get credibility back, and they can't squander it immediately.
Terry Haynes, Pangea Policy founder. Terry, good to see you here, and thanks so much for taking the time. It's got to be at least afternoon some time over in the UK. Thanks so much.
Sure thing.
And thanks for joining us, Inez Ferre, as well, here for the back half of this hour. Coming up, everyone, wealth dedicated to all your personal finance needs. I've got you for the next hour. Stay tuned. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, we're taking a look at the labor market with the latest jobs report. We'll bring you expert advice for your job hunt and the best way to find an auto loan. Yahoo Finance contributor Ross Mack will give you the tips that you need to find the best deal on a car loan. Plus, are you saving as much as you could be? We'll break down how Americans are saving so far in 2024 and what it could mean for your retirement plans. All that and much more throughout today's show. But let's get back to that jobs report. 206,000 jobs were added to the U.S. economy in June. According to this morning's report, unemployment inched above 4% for the first time in over 2 years, 4.1% to be exact. But what did we learn about how much money people in the labor force are earning? For more, I'm joined now by Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, and wage growth is an important factor to look at because it's basically looking at how much salaries are rising, and if that rise means that people have more disposable income to spend. Also, companies have to charge more for their services and goods to maintain that same level of profitability to make up for the increase in cost of their labor. And that tends to fuel inflation. Average hourly earnings on a year-over-year basis increased by 3.9% in June. That's better than the prior month reading, when the annualized reading came in at 4.1%. So it shows wage growth is cooling. In June, average hourly earnings for all employees increased by 10 cents or 0.3% to $35. Compare that to May, when average hourly wages climbed by 14 cents or 0.4% to $34.91. So again, decelerating growth in average hourly wages. And I'll tell you which sectors saw the most wage growth month over month: mining and lodging, manufacturing, construction, financial activities. The sectors where you saw wages actually decline include information, that includes publishing, broadcasting, and telecom, and also private education and health services, and leisure and hospitality actually saw a month over month decline in wage growth.
Excellent breakdown there, Inez, of some of the jobs data that's come out this morning. Appreciate it.
Thank you.
In the June jobs report, we saw gains in government, healthcare, social assistance, and construction. Julia Pollack, who is the ZipRecruiter chief economist, is here to discuss the industries that are hiring right now. Great to see you, Julia, and thanks so much for joining us here on the show today. So where are we seeing some moderation, and then where are there jobs to be found?
So we're seeing some moderation on the services side of the economy. The private sector is seeing fewer jobs being added, and the bulk of hiring now is taking place in government and healthcare. Government hiring is pretty interesting. Those payrolls have risen by about 600,000 over the past year. That's an extraordinary number, mostly on the local government side. Part of this is to do with the fact that it's an election year, and so all eyes are on the performance of our local public schools and our police departments, and there's tremendous demand on ZipRecruiter right now for law enforcement skills.
Interesting. Okay, and so of the demand that you are seeing on ZipRecruiter, what are some of the top searches that are being initiated from those that are looking for jobs too?
So the top search right now is actually a blank search. People don't know what they're looking for. They don't know what's out there. We have a lot of new grads hitting the market who have just finished their training programs in the last couple of weeks and don't really know what's out there. They need help and guidance, and that is why AI is increasingly being used in job search to help people discover jobs and to connect them with opportunities that are a good match for their skills and interests.
What does true normalization look like in the jobs economy? We were having this conversation earlier. 4.1%, sure, the highest that we've seen in about 2 years or so, but again, as we were hearing from some of the economists earlier on during the hours that Yahoo Finance has been live this morning, that's just getting us back to normal.
So historically, this is a very resilient, robust labor market. We've seen job gains of about 177,000 on average the past 3 months. That's actually above what we saw in 2019. when we had job growth of 164,000 a month. The issue now, though, is that the labor market is slackening. So in 2019, we saw these kinds of job gains, but unemployment was falling because participation wasn't rising as quickly. We actually need to add more jobs now, given that the labor market is growing by more than 200,000 people a month, or else we will continue to see unemployment tick upwards. And that is not good for job seekers and workers. I think it's a reason we've seen the job seeker confidence index this month fall to the lowest level since we began measuring it.
What should people who are beginning their job searches or perhaps job hopping, job switching, expect of the wage front?
So wage growth is cooling, but inflation has cooled faster. And so workers are actually getting real wage increases again after a 25-month stretch in which their wages were losing value in real terms after inflation. So the wage picture, I think, is quite rosy and encouraging. And it's not necessarily the case that this wage growth will be inflationary because productivity growth has been pretty strong. So hopefully these wage gains are sustainable.
Certainly. You know, as you're kind of looking across the number of companies that are listing or are actively looking for people to come and help them with their perhaps generative AI projects, or maybe just to be a police officer, you know, with all of the recruitment that you are seeing and tracking across, where are companies perhaps coming off of the hiring freeze bench and saying, okay, now we feel comfortable bringing people back into our headcount?
So there are several places where we saw overall employment levels actually fall at around 2022, but they're gradually rising now. One area is in home building. That was an area that took a hard knock when the Fed raised interest rates. But now it's actually at a high, a post-Great Recession high. We're also seeing tech adding jobs very gradually, month after month. A lot of that is in AI. But that sector had been pretty stagnant for a while, also in response to high interest rates.
You know, just lastly, while we have you, there's a lot of implications when we're getting more economic data, trying to spell out a trend of the employment situation, of what the Fed may do off of all of this data. What is your best anticipation of what we could see in the back half of this year from the Federal Reserve?
Well, I think at this next meeting, the Fed is going to be very seriously debating when to start cutting rates. And I think there'll be a large contingent pushing for a September cut. It's quite possible that we'll see a September cut and another one in December if inflation data keeps heading in this direction.
Julia Pollack, who is the ZipRecruiter chief economist. Julia, great to see you. And thanks again for joining us.
Thanks, Brad.
In the market for a new home, we break down what you need to know before you take on those open houses this weekend. That's right after the break. Stick with us. Buying a home just became a little bit more expensive. Mortgage rates hitting their first weekly increase since May this week. To break down what you need to know if you're in the market for a new home, Jessica Lautz, who is the National Association of Realtors Deputy Chief Economist and Vice President of Research, joins us now. Jessica, great to have you here on the show with us. Okay, so where are we seeing perhaps some continued movement in the housing market, especially knowing that a lot of consumers are hearing headlines like housing prices at all-time highs and trying to figure out where their best entry point is?
Yeah, so it's really difficult for consumers today and really discouraging actually as we hit the summer months, knowing that interest rates are actually back on the climb. Now, we don't know if that's sustained or if we're going to see interest rates really in this range for a substantial period of time. And I think this is probably where we're going to be. When we think about a home buyer today, looking at affordable price points, this is where they're having a very difficult time finding housing inventory that has been very tight. At very expensive price points, we are seeing that more buyers are in that market because they can afford that. And we also know that people have a lot of housing equity, so they're able to make these expensive trades.
Certainly. And as we're thinking about how that's playing into the calculus of buying a new home versus buying an existing home, where are you seeing that trade-off kind of net out among those prospective buyers?
So when we think about the new home market, we know that it had been historically a smaller portion of what it is today. That being said, we know that right now we need more home building than we currently have. Housing starts actually have been pretty flat if we think about the last couple of months of data. So this is not encouraging when we think about the need for more housing starts to come into the market for new housing inventory. If you think about an existing unit, there's many people who are locked into these lower interest rates. If they financed or refinanced their home at 3.5% versus about nearly 7% today, we're talking about a very substantial change in that mortgage payment that they may not be willing to do or cannot pay for that change above $700 a month, really.
Do you see affordability getting any better as the Fed begins to cut interest rates anticipated in the second half of this year?
Well, it's all part of the equation. Certainly mortgage rates, if we see them coming down even a little bit, could be encouraging news for home buyers. But we also know that home prices are continuing to go up. In fact, if we see mortgage rates come down, we could actually see more bidding wars in the housing market today with this really limited housing inventory. And that's just part of the equation that perhaps some people may not feel encouraged to jump into right now. If we look at the housing market today, even with interest rates higher, we know that 30% of homes are moving over the asking price.
So if interest rates are cut and then that impacts mortgage rates as well, potentially more bidders hopping in, and then with that bidding war, you could see the price having even more of a premium on top of it. I mean, then at what point would we finally see enough of the property that is sold through? And for those who may say, all right, well, I'll just build a new home if they have that luxury or are able to do so. At what point would you see the settling of some of that activity and perhaps retrenching to more normalization?
I would say we need to have several years of home building activity that's quite strong to bring in some equilibrium to the market. Because the big thing that we have right now is a huge wave of young adults coming into the housing market, trying to find their first property at the exact same time that baby boomers are hitting retirement, actively in retirement, looking for that perfect home as well. It's putting a lot of pressure on the housing market right now for limited inventory at the same time that current homeowners are unwilling or unable to be able to move.
All right, I want to end this conversation with some actionable tips for those who are excited. They're revved up. They're going out to some open houses this weekend. What do they need to be keeping in mind, Jessica?
Well, stay in close touch with your experts. You want to make sure that you have your realtor on your side, but you also want to make sure that you're keeping in close touch with your mortgage broker to make sure that you can afford the homes that you're looking for.
All right, Jessica Lautz, who is the National Association of Realtors Deputy Chief Economist and Vice President of Research. Good to have you on the program here with us today, Jessica.
Thank you.
Thanks. Rebalancing your investments for the second half of the year. We speak to a portfolio manager on how you can set yourself up for success. It's right after the break. If you're in the market for a new car, getting the right auto loan is important for keeping your budget intact. Here with some auto loan tips is Yahoo Finance contributor and host of Financial Freestyle on Yahoo Finance, Ross Mack. Hey, Ross.
How you doing, brother?
I'm good. Okay, so what do people need to be keeping in mind as they're trying to make sure that affordability is being prioritized, but also protection and coverage when they're making that auto purchase?
First things first, you gotta know your budget when you're in the market for a car, right? I think when we start thinking about what we're spending our money on, quite often we're overspending, especially when it comes to a car. A good rule of thumb, try not to spend more than 10% of your monthly take-home income, right? And so just to give you an idea, the average car note payment for this year, 2024, for a new car is roughly $723, meaning that a person should be making $7,000 take-home income, right? And so obviously that's not the average. So as you can see, quite often a person probably will be overspending when it comes to a car unless they're willing to live within their means. Another thing to think about is you have to prioritize your credit score, because that could be the difference in paying, thousands of dollars just based on purely the interest rate that you're going to get, right? And I think another thing, as you're thinking about your credit score, you want to say, what could I be doing now leading up until that time I purchase my car? Meaning you don't want to make any new big purchases, aka applying for any new credit. You don't want to be closing down any other credit cards or any credit that you have, because that's going to just overall make your length of credit history lower. And another thing to think about is just understanding overall what your affordability. You need to go into the market saying, hey, there are other costs associated with that car, not just the car note. You got insurance, you got maintenance, you got obviously the interest rate and a few other things, gas.
Right. And so if someone has dotted their I's, crossed their T's, everything, and secured themselves a loan, it's now the time to head to the dealership. What are some tips that people should follow to make sure that they stay within their budget when they're making that purchase?
I love that. I think first things first, go online and get pre-approved going into the dealership. I love the concept of going in there saying, hey, I've been pre-approved for $60,000 or for whatever the number is, right? And then that gives you the ability to still stay within that range and not, be tempted with a few other things, right? Because when you go in there, you got to understand that dealer financing often is more expensive, right? I think, the car salesman might make more money if you're using dealer financing as opposed to saying, oh, I'm pre-approved, here's my paperwork, I'm ready to go. And so that's something to think about. Another thing to think about is, understand those add-ons, right? That car salesman say, hey, do you want this extended warranty, or do you want this, or do you want that? It sounds good, but just understand how quickly you can go from a $50,000 car to $65,000 with a few add-ons. So those are the things that I would recommend.
Right, do I need the sport package? Do I need it? Is it gonna get me to work faster? This is just an A to B car. Ross, thanks so much for taking the time.
Always.
Appreciate it. Great to see you. And make sure to check out Financial Freestyle on Yahoo Finance, Mondays, 12 p.m. Eastern with the man himself, Ross Mack. Well, markets, we've been tracking them this morning after both the S&P 500 and the Nasdaq hit fresh intraday record highs. We kick off the second half of the year this week, and you might want to rebalance your portfolio to stay on track. To discuss, we've got Keith Buchanan, Globalt Investments Senior Portfolio Manager, here with us. Keith, great to see you. All right, so let's dive into this. The second half playbook, what does that look like? Where are there hot areas that investors should maybe be kicking the tires?
Well, thank you very much for having me. We're looking at the second half of 2024 with a nuanced, cautious approach. Typically, coming into a second half of the first half we had with so much of the market cap and returns being garnered by just a few stocks, we're looking elsewhere in the market. We feel like those stocks have commanded a lot of attention in market cap, and honestly, the growth that they've displayed has been remarkable. But we want to make sure that there are other spots in the marketplace, particularly in consumer land, in industrials and financials, that perhaps might offer opportunities in the second half of the year, as those few stocks that have again, gotten a lot of attention from the marketplace has to really grow into those expectations in a way that
Keith, I think we're having an issue with your audio. We're going to try and get that resolved here very quickly. Taking a look at the markets, as we were just discussing with Keith Buchanan, the Dow right now is lower, the lone laggard, if you will. It's down by about 0.03%. The S&P 500 in positive territory, the Nasdaq Composite in positive territory. We're going to go to a quick break. That was Keith Buchanan, Globalt Investments Senior Portfolio Manager. We're going to try and square away that audio for you. We'll be right back. Middle-income families continue to remain anxious about the state of the economy, with 2/3 of families reporting their income falling behind the cost of living, though on the upward swing from this time last year. This is all according to the newest survey from Primerica. For more, let's bring in Glenn Williams, the CEO of Primerica. Glenn, great to see you, and thanks for hopping on the show with us. All right, so what are we seeing? What's the feel, the vibe across middle-income families from the data that you're seeing at Primerica?
Well, Brad, it's great to be with you. And as you saw from the headline stat, 2/3 still feel they're falling behind. So I would say middle-income families still feel like they're in retreat financially. We also detect a high level of stress financially from these families. And of course, we all know stress is not good for our physical health nor for our relationships. But within the numbers, we saw that 3/4 are cutting back. And of course, that is actually good. That's what people should be doing, is reprioritizing. The challenge is that half are reducing savings or stopping savings entirely, and 30% can report continued increased credit card usage. So what's happening is they're shifting priorities. That's good when they stop savings or stop spending, but reducing savings and using more credit is not a good trend.
And so those difficult decisions, where are you seeing perhaps the trade-off more largely among households?
Well, it's an item by item process. When we sit down with families, it's always about prioritizing or reprioritizing. And so we sit down with families and explain to them that as much as they love those streaming services or the newest model cell phone, that is preventing them from achieving their more important financial priorities. And the challenge is that time is an ally when you're investing, but it's an enemy when you're borrowing. And so shifting from saving and investing to borrowing is a double negative. And so that's what we try to demonstrate that to families and then help them through the process of making those tough decisions on what's truly important to them and then taking action on those.
Okay, so with this in mind, I was looking through some of the findings from your Middle Income Financial Security Monitor here, and the majority grasp financial basics but not complexities here. Can you break that down a little bit further for us, and where there is understanding about perhaps some of the levers that can be pulled at a household level, but the execution and the complexities are still perhaps daunting at this juncture?
Sure. Well, as humans, we tend to think we have a general understanding of things, but maybe we don't know the specific process needed to really make an impact. So as we sit down with families, clearly they know they need to be saving for the future, particularly for retirement. They need to make sure debt doesn't get out of control. But we see them in action. We sit down with them and first analyze where they are today. And that's where it exposes that what sometimes they think is happening is not exactly what's happening. They're spending more than they think. They're using credit more. They're saving less, or the amount that they're saving is not going to get them where they want to go in time. And so that's where the decision starts. And then we help them with a step-by-step process. I mean, the first thing is you've got to start some savings, even if it's small. You've got to start to reduce your debt. Even if that's a small process, you got to protect your family with term life insurance. So there's some basic steps. And then as families get started, they get a little momentum, and then they find out it's easier to take the next step and the next step. We find out, Brad, it's not usually the information. It's the personal application of the information to their specific circumstances that confuse families. And then it's the motivation to act and continue to act that families need.
That's a great point, Glenn. Just lastly, while we have you here, I was looking through some of the drivers and the lack of financial planning, and anxiety and limited time were two of the top that came up in this report from Primerica. As you're thinking about the small decisions that add up to big solutions or perhaps big savings or smart spending habits, what are the tips that households can employ right now, this weekend even, as they're starting to think about getting into a better financial standing?
Well, I think you hit the nail on the head, Brad. Sometimes it's sitting down with families and just demonstrating that they can do something. It's not hopeless. It's not impossible. And when we sit down with families, they've got to take a look at, as we saw in the survey, it's things like going out that are optional. If you can eat in more often, save a few dollars, use those to invest or pay down debt. Look at your streaming services. That's an area that there's just a lot of expense that sometimes families don't even realize they have or they're not using any longer. Take a look at your electronic devices, the expenses there. So many of these things a generation ago didn't even exist. My generation didn't have to deal with these coming through that phase of life. but now they're things that are optional that people have assumed are mandatory, and they need to go back and say that's not as important as the greater priorities in my life. That's financial security for my family.
All right, I got to finish watching a few Netflix series, and Trigger Warning was on my watch list as well, the movie on Netflix, before I cancel those streaming services here, Glenn. But then I'll take some of that advice you just gave. Thanks so much.
Do that and then pull the plug.
Glenn Williams, Primerica CEO. Great to see you.
Great to be with you.
Thanks. Well, markets mixed here today after both the S&P 500 and the Nasdaq hit fresh intraday record highs. We kick off the second half of the year. That happened this week, and you might want to rebalance your portfolio to stay on track. To discuss, let's bring in Keith Buchanan, Globalt Investments Senior Portfolio Manager, here with us. All right, so let's talk about this second half playbook here, Keith. Where are you seeing some rotation take place, and where are perhaps are investors leaning further in to their portfolio trade?
Thank you very much for having me. We're looking at the second half of this year as an opportunity, again, as you mentioned, to rebalance a bit. We've been really concentrating on large cap growth. We've been in a position now, constantly benefited from that positioning, but now we're looking to become a little more balanced as it's coming into this earnings season, which we think is critically important. Every earnings season is important, but this one is critically important to this bull market we're on because of the 10 largest names, S&P 500, generate very large, disproportionate amount of the growth as well. So as those names have performed and have grown into those multiples, we feel like that's going to become more and more challenging into the second half of this year, into 2025. So this earnings season is really going to be a barometer for where those 7 to 10 names or so will contribute to guidance and S&P 500 earnings in 2024 and 2025 that have baked in a lot of growth, and a lot of that come from those top largest names in the S&P 500.
Keith, it's been a hot Nvidia year, could be a hot Nvidia summer, who knows? I mean, as we're thinking about some of the specific overcrowded trades that investors have piled into, where are you anticipating that we could see a shift, at least in the mindset of where some investors who might have been talking about their own portfolio and trading strategy at the barbecue over the past couple of days are trying to figure out, okay, I've seen insiders taking some profits. Should I be taking profits too? How can investors know when it is the right time to take profits and reallocate them?
We've seen, large cap growth, technology, artificial intelligence oriented names just really make the market really top heavy. And we're looking at spaces outside of that. We've been positioned for that for some time now. But they're looking at spaces like the consumer, which is really driving, this market really kept us out of recession even for the last 4 years of, a turbulent market environment. The middle to high end consumer is doing a little better than those on the ends. We feel like Costco actually is a name that benefits from that shift in spending that's remained more steady with the high and middle income earners as well. The financials, we feel like the steepening of the yield curve has really made those names prop up a bit over the last couple of weeks. Of course, we're coming into, when those names, the money center banks start to report, and we're positioned to benefit from some of that as well. So we're looking at financials, some names and consumer-driven names, a couple of industrials as well that might be oriented as value stocks, but we feel like are positioned to take the mantle of this bull market as the top 10 names, the Magnificent Seven, if you will, coming to some earnings stresses that might hamper those performances from those names going forward in the second half of this year.
Keith, what do you believe the prevailing theme for the earnings season that we're about to go into could be?
Is this growth real? The bottom-up expectation is for 9% growth in 2024. A large portion of that, the majority of that is coming in the second half of this year. Without the top 10 S&P 500 names, that growth is expected to be about 6%. So almost a little over a third of that is coming from just a few names. There will be a lot of attention on the Apples and Nvidia and Microsofts of the world, and rightfully so, because if that earnings growth is 5 instead of 9, the multiple of the market completely changes. So there's a lot riding on this earnings season, particularly for those few names, as the S&P 500, again, has been priced for tremendous growth, frankly, over the second half of this year and next year. Whether we can fulfill that expectation is yet to be seen.
To what extent, just lastly while we have you, Keith, to what extent is the general election here in the U.S. a wrench in portfolios coming into what is expected to be another vitriolic type of event here in the U.S.?
Politics has been interwoven in market dynamics for some time now. We think this year is going to be one of those banner years where politics dictates the movements in fixed income and equity markets, particularly here in the U.S. Also, from a currency standpoint, we've seen that change since the debate on Thursday in a pretty dramatic way. It's shifted very hard in a kind of a pro-Trump manner Friday and then some on Monday. But that somewhat shifted back in this week that is really lies holiday week, so it's really hard to have any main takeaways. But as this second half wears on, we will see that become more and more a focus of the marketplace and those bets that are taking place and being placed, depending on the polls, will come to a head in November. I think down ballot as well, we see some shifts as far as where spending could be and what what parts of the market can benefit from that. Also being an opportunity and potentially even a challenge for some parts of the equity market. Those bets, again, it's fairly early to place and really have hard takeaways from where we are right now politically. We kind of shy away from that until things come into more focus later in the fall. We think the earnings driver really was pushing markets back and forth, especially from a monetary policy standpoint as well. We saw the jobs report this morning, how that plays into what the Federal Reserve's reaction function may be and how that may change coming into the fall. We feel that's a more predominant dictator of the direction of the markets at this point.
Certainly. Keith Buchanan, Global Investments Senior Portfolio Manager. Great to see you, Keith, and thanks so much for joining us today.
Thank you.
Certainly. Up next, an encore showing of Lead This Way with the co-founder and CEO of Amsom.
when your sister-run noodle company hits grocery shelves nationwide.
When I was a kid and I was like always trying to like hide my lunch, or I just didn't want people to come over when my mom was making something particularly aromatic. Fast forward to today where I get a chance to proudly put this in front of the country.
The types of aromatic dishes Vanessa Pham once tried to hide from the world are now on full display in vibrant packaging on the shelves of major retailers. The brand's colorful journey is also on full display across the internet, thanks to Pham's Now Tell the World attitude.
Every time I go into the grocery store, I always got to take the phone out and do like the selfie video. It always feels surreal.
Amsom is a sauce and noodle startup partnering with prominent Asian chefs to offer premium, authentic flavors. This isn't your usual microwavable instant noodles you might think of. A huge step Vanessa and her sister Kim say is part of their personal mission to shake up ethnic aisles at grocery stores and bring these dishes to the mainstream. But the recipe to get here, well, it wasn't a simple one. A global pandemic, Silicon Valley Bank's collapse, and the challenges any 24-year-old would face leading a brand new startup all stood in the way of her vision and mission of spreading her values and culture through the love of food.
Tell us what Amsom means.
Yes.
I mean, that in itself just symbolizes so much of the mission.
Amsom is actually based on a Vietnamese word, Amsom. And in Vietnamese, it means rowdy, rambunctious, riotous. It's actually a negative term. It's what our parents would use when they were trying to scold us. And Kim and I were really inspired by that energy. What if we kind of turn that on its head and celebrate that aspect of who we are? And Amsom is all about being proud and loud, especially when the stereotype of Asian Americans in America is kind of like submissive or docile. Amsom is our true kind of energy and ethos and spirit.
While hiking in Bolivia in 2018 with her more free-spirited sister, the once risk-averse Pham decided to lean into what she felt was her true ethos and leave her steady consulting career behind.
We instantly circled around the mission and the industry. And the mission is to educate on multitudes within Asian America, honor and celebrate Asian cuisines and flavors. And the industry just had to be food, because for us, it was a love language. It was how we first really learned to engage with our culture as Vietnamese Americans and daughters of refugees.
With nothing more than what the two sisters had in the bank, they set out on their mission to create something unique. Embracing their roots was a catalyst to create Amsom, as they saw an opportunity to tap into the ethnic food market, which is set to reach $84.7 billion by 2034. And investors saw the opportunity too, as a number of them, including the co-founder of the luggage company Away, Jen Rubio, founder of the online wedding platform Zola, Shanlin Ma, and former Whole Foods executive turned VC founder Ellie Truesdell of New Fair Partners, helped fund the Pham sisters' vision. For Pham, embracing her personality, well, that was how she learned to lead the brand.
Do you see yourself as more of a risk-forward leader now? Do you feel like you're tapping in to that mission?
I would say that the person who I was when we were first building Amsom is very different than the person I am today. I think my proud and loud has actually been embracing who I am, which is very sensitive, very empathetic, lots of feelings, and learning to see that that's a huge strength as a leader if I don't make myself wrong for that or suppress that.
You also founded the company at such a young age. I think you were, 24?
I was 24,
24,
a baby, yeah.
How did you push through that noise and say, I may be young, but I'm making a difference?
Yeah. I would say the loudest noise was actually my own self-doubt at the time. And so much of this journey has been actually working with my kind of inner narratives and dialogue. And now I think I'm kind of my own hype woman. So
A hype woman with a core team who have helped her create not just food products, but an environment fueled by the brand's identity and Pham's own energetic outlook, something she has embedded in the culture.
Everybody here is incredibly talented, incredibly driven, and I think enlivened by the mission of Amsom. And I absolutely lean on the team. I think, a strong leader must and should trust and empower those that work with them. I learn from the team every single day.
FAM's journey in starting Amsom has definitely been a learning experience. As they sought out the right manufacturing partner, which they found in Chicago, back in Brooklyn, another huge lesson came their way: how to launch a specialty food business in the middle of a global pandemic.
When we started out building Amsom, we were just wide-eyed. We didn't know what could come. And before we even launched, the first big challenge came. Do we launch in the midst of this pandemic at the start of it, or do we pause and wait it out? And what we realized is that folks during this time are going to be at home. They're going to be wanting to feel a sense of connection and home. And we felt like that's what Amsom's all about. And I think we did make the right decision, despite some folks warning us that it could be a difficult time.
Who were those folks? Those investors, those people who backed you? How did you push over that?
One of my philosophies as a leader is, you've got this whole kind of network of folks, whether they're investors or, other folks. And I believe it's so important to, take in their input, their advice, and their experience like a sponge. But at the end of the day, coming together with, your team, centering your values and finding the best path forward for the company is really, that power is yours. We decided this was the time that we wanted to bring this company to the world.
Just 3 years after launching during COVID, FAM faced another major obstacle.
Regulators shut down Silicon Valley Bank. The FDIC has taken control of the bank deposits. So what's the fallout, the ripple effects?
Leaving the startup without access to their capital right before the brand was scheduled to launch their second product line, saucy noodles.
Nothing can really prepare you for that type of, uncertainty. I immediately had to figure out what our options were. And at the same time, Kim and I started working together on how we wanted to communicate what was going on to our community. So we wanted to center our values around transparency, and around bringing them in.
FAM and her sister were transparent with their community in a way that you might expect from the young founders on social media.
We did not know what would happen in the coming days. And so we put our heads together that Saturday morning and wrote something from the heart. Running a proud and loud business doesn't always mean being celebratory. So let's talk about how SVB's collapse poses a major existential threat to many small businesses, including Amsom. I think while we were still very scared and nervous, we felt deeply heartened by the people that showed up for us.
Talk about what values you hold closest to you as a leader.
One of the values that I've really centered in my journey as a leader is being heart forward, which is something that I don't think was necessarily historically celebrated in leadership. It was about being, decisive, being kind of just like leading with certainty and confidence, sometimes at the expense of your humanity. And I feel like at the early stages of my journey, I tried that on, and I was always making mistakes when I was in that, headspace of being something that I wasn't. And so the last couple of years, I've started to accept more of who I am in my leadership. If I'm, working on something in my own journey, I'm open to sharing that. And I hope that that kind of invites people to feel confident and accepted in who they are at Amsom too.
When your team thinks of you as a leader, what do you hope is the message that you're getting across?
I really hope that everybody at Amsom feels valued for who they are and what they bring to the table, and that they feel they have room to learn, to sometimes make mistakes. It's about celebrating your truth and exactly what makes you you. I want Amsom to be the type of place where people are learning and expanding, but also feeling great pride in their kind of natural strengths.
FAM and her team are determined to fill a white space. Think Kava and how it's setting out to fill the white space for fast casual Mediterranean food, or what Chipotle has done for fast casual Mexican cuisine. And now Amsom aims to fill the void for premium, authentic Asian flavors in the packaged food market. That market is expected to grow around 50% globally by 2030. And while Amsom doesn't disclose its finances publicly, the suggested retail price for its saucy noodles and its cooking sauces range from nearly $4 to $5. Since launch, the brand has sold 4 million products and expanded its presence to over 2,000 stores without losing sight of its roots. Pham isn't satisfied yet, though. Far from it. She wants, in her own words, proud and loud Asian flavors to be mainstream.
I want to see Amsom become a cultural force, a household name that continues to honor Asian American communities and flavors and culture every single day. I want us to be in homes across the country, but still hold that ethos and that heart that we do today.
An ethos and heart that Pham and her sister inherited from their parents, who, as refugees, weren't able to take the same kinds of risks.
Your parents must be so proud of you. What do you think they think about all that you have done?
They tell us all the time, which I really appreciate. They tell us that we are honoring our family history by the work that we do, and because they're refugees and they've, built the life we have today, it is my, biggest life stream to honor them and do right by them.
If there's one moment that really felt like, wow, I made it, we did it, what would that moment be?
It's when we've shown the people who helped to get us here what we've done. And so it's really my grandparents. We were featured in a spread in El Vietnam, and it's written in Vietnamese. So I cannot wait to bring it to them because they can read it and really understand that. And that'll be the moment, I think, when it really hits me, what we've accomplished.
We've all heard Americans are struggling to save for retirement, but are they? The average retirement account balance increased by 19% last year. That's compared to 2022. And more than 4 in 10 people raised the amount of money they set aside into their 401k accounts, according to a Vanguard report. To discuss the study, Yahoo Finance's very own Carrie Hannon is here. Hey, Carrie.
Hey, Brad, great to be here. Yeah, we all hear so much doom and gloom about people not saving enough for retirement or being woefully behind, that this just was very encouraging to see Vanguard take a look back at 2023, and they saw some really positive, optimistic trends. People were saving more, and people were contributing more to their accounts. And so, let's break down what this happened, what sort of is behind all of this. And the biggest trend is auto enrollment and auto escalation. And what that means is employers automatically put people into their employer-provided retirement account, their 401k, and then they raise it up each year. So it kind of gets away from that inertia of people not making that decision to get rolling and to increase the amount. This has done a huge amount in pushing people to save more, and I think it's a really great trend. Employers have also doubled the amount that they contribute as a match to 4% or more. It used to, a decade ago, it was about half of that. So that's fantastic news as well. And the second thing that's behind it, Brad, in many ways, is target funds. Target funds have become, they absolutely rule the day now. And most people are in these target funds, which, as the listeners know and the viewers know, it's set and forget, right? You make your investment, and then as the markets go up and down, and as you age, they gradually reduce your risk. Say you're going to retire in 2035. Then as you get towards that date, it goes from equities down to more fixed income. And it really helps people not trade as much, which is quite good for these accounts because there's not a lot of shaking up. And for younger workers, Vanguard has found that it's super helpful because they used to be not invested enough in equities. And so as a result, they lost out on growth. And this helps them get in at a better sort of composition of their retirement account for their future. So that's great news. They another study I looked at, Transamerica, showed that younger workers are actually starting to save for retirement at age 20, Gen Z, and that compares to 25 for millennials, and Gen X started at 30 or so. So we're seeing a movement to start saving earlier, which I absolutely love. Now, before I get too crazy, I got to say there was one sort of caveat to the Vanguard report I need to mention, is that more people than ever rated their retirement accounts. So this is a small percentage, but I've got to tell you, it's worth looking at and a concern. And they did it mostly probably prompted by inflation for medical bills and housing expenses. But as we know, if you do that, if you withdraw from your retirement account for these things, and there are some exceptions to this rule, but you generally are, if you're not 59 and a half, you're going to pay a 10% penalty and you're going to pay tax, and that money's gone. So those are just a couple of things that kind of percolated out of that. And my final point is that even though I'm so excited to see these positive numbers for once, the fact is half of Americans still do not, who work in the private sector, do not have access to an employer-provided retirement plan. And what that means is they really do have to voluntarily, jump in and get going.
Carrie Hannon, a lot of gems from that study. Appreciate you breaking it down for us. Thanks so much, Carrie.
Thanks, Brad.
Certainly. Hey, everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. Stay tuned here on Yahoo Finance for Market Domination with Jared Blickery and Josh Lipton. That comes up at 3 p.m. Eastern. You don't want to miss it.